Hello everyone, and welcome to our first lesson on recording financial transactions in the FA1 chapter. As promised, we will start from the very beginning and we'll keep everything very easy to understand. Today, we're going to focus on two key areas: the definition of accounting and the definition of financial accounting. First, we'll provide you with 5 very good definitions of accounting. After that, we'll take a closer look at 3 of these definitions to help you understand them better. Then, we'll move on to 5 of the most credible definitions of financial accounting. Again, we'll explain and interpret 3 of these definitions in detail. Don't worry at all. Our goal is to make your journey as smooth and easy as possible. We'll break everything down step by step, and you'll have a solid grasp of these concepts in no time. Remember, every expert started as a beginner, just like you, and with practice and patience, you'll succeed. Stay motivated, keep a positive mindset, and remember that each lesson is a step forward in your learning journey. We're here to support you every step of the way, so let's get started and make this an exciting and successful learning experience together. Here are 5 highly regarded definitions of accounting from authoritative sources. 1. American Institute of Certified Public Accountants, AICPA. Definition: accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events, which are, in part at least, of a financial character, and interpreting the results thereof. Source: AICPA Committee on Terminology. 2. International Financial Reporting Standards, IFRS. Definition: accounting is a system of recording, summarizing, and analyzing financial transactions to provide useful information to stakeholders. Source: IFRS Foundation, Conceptual Framework for Financial Reporting. 3. Financial Accounting Standards Board. Definition: accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Source: FASB, Statement of Financial Accounting Concepts Number 1. 4. Oxford English Dictionary. Definition: the process or work of keeping financial accounts. Source: Oxford University Press. 5. Investopedia. Definition: accounting is the systematic and comprehensive recording of financial transactions pertaining to a business. It also refers to the process of summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. Source: Investopedia, Definition of Accounting. These definitions encompass the essential functions and purpose of accounting, offering a broad understanding suitable for various contexts. Let's break down and interpret the definition of accounting provided by the American Institute of Certified Public Accountants, AICPA, for a beginner. AICPA definition: accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part at least, of a financial character, and interpreting the results thereof. Interpretation. 1. Art. Accounting is referred to as an art because it involves applying principles, judgments, and creativity in recording and reporting financial information. 2. Recording. This means keeping a detailed and accurate record of all financial transactions. Think of it as writing down everything that happens financially in a business. 3. Classifying. After recording the transactions, they are sorted into categories. For example, all sales transactions are grouped together. All expense transactions are grouped together, and so on. 4. Summarizing. This involves compiling all the recorded and classified transactions into reports that are easy to understand. This usually means preparing financial statements like the income statement and balance sheet. 5. Significant manner and in terms of money. This emphasizes that only transactions that can be measured in monetary terms and are significant to the business are recorded. 6. Transactions and events of a financial character. This specifies that accounting deals with events that have a financial impact on the business, like sales, purchases, salaries, etc. 7. Interpreting the results. Finally, accounting involves analyzing the financial data to understand what it means for the business. This could involve determining how profitable the business is, how well it is managing its expenses, or how much cash it has available. Let's interpret and explain the definition of accounting provided by the International Financial Reporting Standards, IFRS, for a beginner, along with a comprehensive example. IFRS definition. Accounting is a system of recording, summarizing, and analyzing financial transactions to provide useful information to stakeholders. Interpretation. 1. System. This indicates that accounting follows a structured and organized process with specific rules and procedures. 2. Recording. This is the process of documenting every financial transaction that occurs in a business. It involves noting down all monetary exchanges. 3. Summarizing. After recording the transactions, the next step is to condense this information into a more understandable and manageable form. This usually involves creating financial statements such as the income statement, balance sheet, and cash flow statement. 4. Analyzing. This involves examining the summarized financial data to gain insights into the business's performance and financial position. It helps in understanding trends, identifying problems, and making decisions. 5. Financial transactions. These are exchanges of money or value that affect the business's financial situation, such as sales, purchases, payments, and receipts. 6. Useful information. The end goal of accounting is to provide information that is helpful and relevant for decision-making. 7. Stakeholders. These are the individuals or groups who are interested in the financial information of the business, such as owners, investors, creditors, management, and regulatory agencies. Let's break down and interpret the definition of accounting provided by the Financial Accounting Standards Board, FASB, in a simple way for a beginner. FASB definition. Accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Interpretation. 1. Identifying. This means finding and recognizing the financial transactions that need to be recorded. For example, every time you sell a product, buy supplies, or pay an employee, these are transactions that should be identified. 2. Measuring. After identifying a transaction, you determine its value in monetary terms. For instance, if you sell a product for $50, you measure the transaction as $50. 3. Communicating. This involves sharing the recorded information with others. Typically, this is done through financial statements like income statements, balance sheets, and cash flow statements. 4. Economic information. This refers to any data related to money and finance within a business, like sales, expenses, assets, and liabilities. 5. Informed judgments and decisions. The goal of accounting is to provide clear and accurate financial information so that business owners, managers, and other stakeholders can make smart decisions about the business. Here are 5 of the best and most credible definitions of financial accounting, along with their sources. 1. Financial Accounting Standards Board, FASB, definition. Financial accounting is the process of preparing financial statements that companies use to show their financial performance and position to people outside the company, including investors, creditors, and tax authorities. Source, FASB. 2. International Financial Reporting Standards. Definition. Financial accounting involves the preparation of financial reports for external use, ensuring transparency, accountability, and efficiency in financial markets. 3. American Institute of Certified Public Accountants, AICPA. Financial accounting is focused on the preparation of financial statements that provide information about a company's performance, financial position, and cash flows to external users for decision-making purposes. Source, AICPA. 4. Chartered Institute of Management Accountants. Definition. Financial accounting is the field of accounting concerned with the summary, analysis, and reporting of financial transactions related to a business. CIMA. 5. Investopedia. Definition. Financial accounting is the process of recording, summarizing, and reporting a company's business transactions through financial statements. Source, Investopedia. These definitions give a clear picture of what financial accounting is and emphasize its role in providing important financial information to people outside the company. Here's the definition of financial accounting from the Financial Accounting Standards Board, FASB, explained simply. Definition: financial accounting is the process of preparing financial statements that companies use to show their financial performance and position to people outside the company, including investors, creditors, and tax authorities. Explanation. 1. Preparing financial statements. Financial accounting is about creating reports that show how a company is doing financially. These reports include things like how much money the company made, income, how much it spent, expenses, and what it owns and owes, assets and liabilities. 2. Financial performance and position. The goal is to provide a clear picture of the company's financial health. Performance refers to how well the company is doing in terms of making a profit or loss. Position refers to the company's overall financial situation at a specific time. Number 3, people outside the company. These reports are meant for people who are not directly involved in running the company, but have a stake in it, like investors who want to know if they should put money in the company, or creditors who want to ensure the company can repay its loans. Example, scenario. Imagine you have a small bakery. 1. Preparing financial statements. At the end of the month, you create a few key reports. Income statement. Shows how much money you made from selling baked goods and how much you spent on ingredients, wages, and other expenses. Balance sheet. Shows what your bakery owns, like ovens and cash, and what it owes, like bills for supplies. 2. Financial performance. You see from your income statement that you made $1,000 in sales and spent $700 on expenses, leaving you with a profit of $300 for the month. Number 3. Financial position. Your balance sheet shows you have $500 in cash and $200 in unpaid bills, giving you an idea of your bakery's financial health. These financial statements help anyone interested in your bakery, like potential investors or banks, understand how well your bakery is doing and whether it's a good investment or if you're able to repay a loan. Here's the definition of financial accounting from the International Financial Reporting Standards, IFRS, explained in a simple way. Definition: financial accounting involves the preparation of financial reports for external use, ensuring transparency, accountability, and efficiency in financial markets. Explanation. 1. Preparation of financial reports. Financial accounting is all about making reports that show how a company is performing. These reports include details like revenue, expenses, and overall financial health. 2. External use. These reports are meant for people outside the company, such as investors, creditors, and regulators. They help these people understand the company's financial status without being directly involved in its day-to-day operations. 3. Transparency, accountability, and efficiency. Financial accounting ensures that the financial information is clear. Transparency, that the company is responsible for its financial actions, accountability, and that the financial processes are effective and streamlined, efficiency. Example, scenario. Imagine you run a small online bookstore. 1. Preparation of financial reports. At the end of the year, you create income statement, shows your total sales, costs of books and shipping, and the profit you made. Balance sheet lists your assets, like books and cash, and liabilities, like unpaid bills. 2. External use. If you're looking to get a loan from a bank, the bank will review these financial reports to decide if they should lend you money. 3. Transparency, accountability, and efficiency. By preparing these reports accurately and clearly, you make sure that the information about your bookstore's finances is open and understandable. You show that you are managing your finances responsibly. You keep your financial processes smooth and straightforward. These reports help others see how your bookstore is doing financially and ensure that your financial practices are honest and effective. Here's the definition of financial accounting from the American Institute of Certified Public Accountants, AICPA, explained simply. Definition. Financial accounting is focused on the preparation of financial statements that provide information about a company's performance, financial position, and cash flows to external users for decision-making purposes. Explanation. 1. Preparation of financial statements. Financial accounting involves making key reports that show how a company is doing. These include statements that detail income, expenses, and overall financial health. 2. Company's performance, financial position, and cash flows. Performance. How much profit or loss the company has made over a period. Financial position. What the company owns, assets, and owes, liabilities, at a specific point in time. Cash flows. How money is coming in and going out of the company. 3. External users. These financial statements are meant for people who are not directly involved in the company, but need to make decisions based on the company's financial information, like investors, lenders, or analysts. 4. Decision-making purposes. The goal is to provide clear and useful information so these external users can make informed decisions, such as whether to invest in the company or provide it with a loan. Example. Scenario. Imagine you own a small restaurant. 1. Preparation of financial statements. At the end of the month, you prepare. Income statement. Shows your total revenue from food sales, expenses for ingredients and staff wages, and your net profit or loss. Balance sheet. Shows what your restaurant owns, like kitchen equipment and cash, and what it owes, like unpaid bills. Cash flow statement. Details how cash is coming in from sales and going out for expenses. 2. Company's performance. Your income statement reveals you made $5,000 in sales and spent $4,000, leaving you with a $1,000 profit. 3. Financial position. Your balance sheet shows you have $2,000 in cash and owe $500 in bills. 4. Cash flows. Your cash flow statement helps you see that your restaurant's cash balance increased by $500 this month. These financial statements help external users, like potential investors or lenders, understand how well your restaurant is performing, what its financial position is, and how its cash flows are managed, guiding their decisions about getting involved with your business. That wraps up today's lesson on ACCA FA1 recording financial transactions. I hope you found it helpful and enjoyable. Remember, every bit of effort you put in now will pay off in your exams. Stay motivated, keep practicing, and I'll see you in the next lesson. Together, we'll make sure you're fully prepared to succeed. Keep up the great work, and don't forget to like and subscribe for more. See you soon. Welcome back, everyone. First, I want to apologize for the delay. Thank you for your patience. Now that we're all here, we'll dive right back into the lesson. A quick reminder, make sure you have your notebooks ready to take notes because not everything will be on the slides. Writing down key points and examples will really help you understand the concepts better. Let's make sure your study journey stays smooth and easy, just as we promised from the start. A business transaction is when something of value, like money, goods, or services, is exchanged between two parties. Simply put, whenever property, like products or money, changes hands in a business, it's a business transaction. For example, in a clothing store, when a customer buys a shirt for $20, the store gives the shirt to the customer, and the customer gives $20 to the store. Here, property, the shirt and money, is changing hands, so it's a business transaction. This happens every time the store sells an item, pays for stock, or even when it pays rent for the store space. Property, money or goods, is exchanged. According to BPP, the main types of transactions are cash transactions and credit transactions. These two categories cover how money flows in and out of a business. Cash transactions involve immediate payment, while credit transactions involve a delay or a gap in time between the transaction and the payment. Now let's explore these types in more detail and see how they apply to sales, purchases, and other important business transactions. Main types of transactions: sales and purchases. In business, the core transactions are related to selling, sales, and buying, purchases. Both of these transactions can either be cash, immediate payment, or credit, payment after a period of time. 1. Sales transactions. A sales transaction is when a business sells goods or services to a customer. The payment for this sale can either be received immediately, cash sales, or later, credit sales. Cash sales. A cash sale happens when the customer pays for goods or services immediately at the time of the transaction. The payment can be in cash, by card, or via bank transfer. Example. Imagine you own a clothing store. A customer buys a shirt for $20 and pays with their debit card at the counter. This is a cash sale because the payment is received right away. A credit sales. A credit sale happens when a business allows the customer to take the goods or services now, but the payment will be made later. There is a gap in time between when the sale happens and when the business receives the money. Example. Suppose you own a furniture store and a customer buys a sofa for $1,000 on credit. The customer takes the sofa today but agrees to pay you within 30 days. This is a credit sale because you are waiting for the cash to arrive after a 30-day gap. 2. Purchase transactions. A purchase transaction happens when a business buys goods or services. The payment can be made immediately, cash purchases, or later, credit purchases. A cash purchase occurs when a business pays for goods or services immediately at the time of the transaction. Example. You own a cafe and you buy coffee beans for $100, paying for them in cash on the spot. This is a cash purchase because the payment is made right away. Credit purchases. A credit purchase happens when a business receives goods or services now and agrees to pay the supplier later. This creates a gap in time between when the goods are received and when the payment is made. Example. Imagine your cafe buys coffee beans worth $500 from a supplier, and they allow you to pay in 60 days. You receive the beans today, but will pay after the 60-day gap. This is a credit purchase. Other types of transactions. 1. Payroll transactions. Definition. Payroll transactions involve paying employees for their work. This includes wages, overtime, bonuses, and any deductions for taxes or benefits. Example. If you have 3 employees at your cafe and you pay each of them $800 at the end of the month, that's a payroll transaction. These payments include tax deductions such as income tax and Social Security contributions. 2. Depreciation transactions. Definition. Depreciation transactions account for the loss in value of a long-term asset over time. It's an expense recorded in the books, but it doesn't involve immediate cash. Example. Suppose you bought a delivery van for your cafe for $20,000. Every year, the van loses some value due to aging and usage. You record $2,000 in depreciation annually. This is a depreciation transaction. No cash is spent, but the van's value is decreasing. 3. Loan transactions. Definition. Loan transactions occur when a business borrows money from a bank or financial institution and agrees to repay it with interest over time. Example. Let's say you borrow $10,000 from the bank to expand your cafe. You repay this loan in monthly installments over 3 years. These repayments are loan transactions because the business is gradually repaying the loan amount and interest. 4. Expense transactions, including taxes. Definition. Expense transactions cover the costs of operating a business, such as rent, utilities, office supplies, and taxes. Example. Every month, your cafe pays $1,500 for rent, $200 for utilities, and $300 in taxes. These are expense transactions because they are regular payments made to keep the business running, including tax payments. 5. Dividend transactions. Definition. Dividend transactions occur when a business distributes a portion of its profits to its shareholders. Example. If your cafe made a profit of $50,000 and you decide to distribute $10,000 to your investors, this is a dividend transaction because it involves sharing the business profits with shareholders. Recap for starters. Cash transactions are when money is exchanged immediately at the time of the transaction. Credit transactions involve a gap in time between when the transaction happens and when the payment is actually received or made. Every type of transaction impacts the financial health of a business, and it's crucial to keep track of them to manage cash flow and financial reporting. Understanding these transactions will help you make sense of the different financial activities in a business and how they are recorded. Understanding the concept. A business is separate from its owners. When we start learning about accounting, one of the most important ideas to grasp is that a business is treated as a separate entity from its owner. This means that in accounting, we see a business as having its own identity, completely distinct from the personal life and assets of the person or people who own it. This separation is crucial because it helps keep personal and business finances clear and accurate. Imagine you own a small business, but you also have personal belongings and a bank account. Accounting principles require that your business finances are managed separately from your personal assets and liabilities, even though you might own both. This principle is known as the business entity concept and is a foundational rule in accounting. Let's break down a few terms used in this concept so it's crystal clear. 1. Entity. This is the broadest term we use to refer to any organization formed by people with a common goal. An entity could be anything: a multinational corporation, a small family-owned shop, a government office, or even a local sports club. The key point is that people have come together to achieve a specific aim. 2. Business. A business is a type of entity, but specifically refers to organizations that exist to make a profit through trading or providing services. For example, a sole trader, partnership, or large corporation are all types of businesses. 3. Company. A company is an entity structured in a particular legal form and often has limited liability for its members, owners, or shareholders. This means the personal assets of the owners are protected in case the company faces financial trouble. Not all companies are businesses, though. Many charities are registered as companies, too. 4. Firm. This term is a bit more vague and is sometimes used interchangeably with business or company. Often it refers to a partnership like a law firm or accounting firm that is not a formal company with limited liability. The accounting convention, treating business as a separate entity. The idea that a business must always be seen as separate from its owners is a core accounting rule. Whether you own a company, are a sole trader, or work in a partnership, the business is considered distinct from you, the owner. Here's an example. Let's say a sole trader withdraws money from their business to cover a personal expense. This transaction has two parts. Money leaves the business's cash decreases, and it's received by the owner as a personal gain. Accounting keeps these two parts distinct. It's recorded as a transaction where money goes out from the business side, but on the personal side, it's treated as the owner's income or withdrawal. The dual effect of financial transactions. Now that we understand the separation of business and owner, let's look at another critical concept in accounting: the dual effect of financial transactions. In accounting, every transaction has two sides, what we call a debit and a credit. This is the foundation of double-entry bookkeeping, a system that keeps records balanced. Let's break down a simple example. Imagine your business buys a piece of equipment, a non-current asset, for cash. This transaction affects the accounts in two ways. Debit: the value of non-current assets, equipment, increases. Credit: the cash balance decreases because money is used to buy the equipment. This dual effect means that both sides of the transaction, the cash used and the equipment acquired, are recorded in the accounts. The goal is always to keep the accounting equation balanced, where total debits equal total credits. Recap 1. A business is separate from its owners. This rule keeps personal and business finances clear and manageable. 2. Entity versus business versus company versus firm. These terms help distinguish between different types of organizations. 3. Double entry bookkeeping and the dual effect. Every transaction affects two accounts with a debit and a credit entry, ensuring accuracy in financial records. By following these principles, accounting provides an accurate picture of a business's financial health, allowing us to clearly see how resources are being used and managed. In the next chapter, we'll explore the accounting equation in detail, which is the foundation for all double-entry bookkeeping. This will build on what we've discussed and show how assets, liabilities, and equity are kept in balance. Welcome to today's lesson. Welcome, students. Today, we're diving into an important topic that forms the backbone of every business. We'll be covering the following areas. 1. What is business documentation? 2. The history of business documentation. 3. Importance of business documentation in today's world. 4. Why document business transactions? 5. Types of documentation, external and internal. 6. External documentation in business transactions. 7. Internal documentation in business transactions. 8. Role of the accounting system. To start simply, documentation is the organized collection of records, reports, and written materials that capture everything happening within a business. It's essential for keeping things running smoothly, making informed decisions, and staying compliant with laws. Let's explore how and why documentation is so valuable. What is business documentation? Business documentation refers to the organized collection of all records, reports, and written materials that document various aspects of a business's operations. These documents provide a detailed record of a company's internal and external activities, helping to facilitate business operations, ensure compliance with legal requirements, and maintain a clear communication framework within the organization. Business documentation includes a wide variety of documents, such as financial documents, invoices, receipts, ledgers, financial statements, e.g. balance sheets, profit and loss statements, and tax filings. Legal documents, contracts, agreements, licenses, and compliance records. Operational documents, business plans, strategic plans, policies, and procedures. Human resources documents, employment contracts, payroll records, employee evaluations, and training materials. Marketing and sales documents, sales reports, customer contracts, advertising material, and market research reports. These documents are critical in helping businesses record and communicate their transactions, manage operations efficiently, and ensure transparency and accountability. The history of business documentation. The history of business documentation is deeply tied to the evolution of commerce, trade, and written communication systems. Here's a detailed look at its development. 1. Early records in ancient civilizations, 4000 BCE, 500 CE. The earliest forms of business documentation can be traced back to ancient Mesopotamia, where the Sumerians developed the first writing system known as cuneiform around 3500 BCE. Clay tablets were used to record transactions, inventory, taxes, and trade agreements. This laid the groundwork for keeping formal records of commercial activities. Ancient Egypt also contributed to early documentation practices. Scribes used papyrus to document government policies, trade transactions, and tax records, crucial for running a centralized economy. Ancient Greece and Rome developed more sophisticated systems of documentation. Roman merchants kept ledgers, often referred to as codices, to track income and expenses, and contracts were written on tablets or scrolls to document business agreements. 2. The Middle Ages, 500 CE to 1500 CE. During the medieval period, the growth of commerce across Europe led to a more widespread use of written business records. As trade routes expanded and banking systems began to develop, merchants needed a reliable way to track debts, credits, and transactions. Double-entry bookkeeping emerged in the late 13th century in Italy, particularly in cities like Venice and Florence. The practice was formalized in 1494 by Luca Pacioli, an Italian mathematician and Franciscan friar, in his book Summa de Arithmetica. Double-entry bookkeeping became a fundamental innovation in business documentation, allowing businesses to keep accurate records of assets and liabilities. Legal documentation became more important as commercial contracts and property laws evolved. Merchants and traders kept contracts in written form to resolve disputes. 3. The Industrial Revolution, 18th to 19th century. The Industrial Revolution dramatically changed the way businesses operated, leading to the formalization of many documentation processes. Financial documentation became more sophisticated with the establishment of corporations and joint stock companies. Businesses were required to produce more comprehensive financial statements and annual reports to attract investors and comply with new regulations. The rise of railways, factories, and large-scale enterprises increased the complexity of business operations, making detailed operational and financial records essential. The development of the typewriter in the late 19th century further streamlined the process of creating business documents. 4. The 20th century, modernization of business documentation. In the 20th century, the evolution of business documentation continued with the rise of globalization, technological advancements, and stricter regulatory requirements. The introduction of accounting standards, such as GAAP, generally accepted accounting principles, created a framework for financial documentation that ensured consistency and transparency in business reporting. The establishment of labor laws and corporate governance standards also required companies to maintain meticulous employment and operational records. Computers and digital documentation revolutionized the way businesses store and manage documents. The introduction of word processing software, spreadsheets, and databases in the 1980s and 1990s made it easier to create, edit, and store business documentation electronically. 5. The 21st century, digital transformation. The 21st century has seen a massive shift toward digital business documentation, with cloud computing, automation, and data analytics playing a significant role. Digital records have replaced paper-based systems in most modern businesses, making it easier to organize, search, and secure vast amounts of data. Electronic signatures and online contracts have become common, allowing businesses to formalize agreements without physical paperwork. Compliance requirements, such as data protection regulations, e.g. GDPR, have made proper documentation and management systems more crucial than ever. Enterprise resource planning ERP, systems, and other digital tools now manage everything from supply chain documentation to payroll and accounting, allowing for seamless integration of business processes. Importance of business documentation in today's world. Today, business documentation is not just about recording information. It's about streamlining operations, ensuring legal compliance, and making informed decisions. Good documentation systems help businesses maintain accuracy in financial reporting and operational activities, facilitate communication across departments and with external stakeholders, ensure compliance with laws and regulations, provide transparency for shareholders, regulators, and the public, support decision-making by providing clear, organized information. In conclusion, business documentation has evolved from ancient clay tablets to sophisticated digital systems that power global commerce today. It remains a cornerstone of efficient and transparent business operations. Why business transactions should be documented. 1. Legal compliance. Documenting business transactions ensures that a company is complying with local, national, and international laws and regulations. Many legal frameworks, such as tax laws, corporate governance standards, and labor laws, require businesses to keep accurate records of their transactions. Without proper documentation, businesses could face legal penalties, fines, or even litigation. 2. Financial accuracy. Recording every transaction allows a business to track its income, expenses, assets, and liabilities accurately. This documentation helps in creating financial statements like profit and loss statements, balance sheets, and cash flow statements, which are crucial for evaluating the financial health of a business. 3. Audit and accountability. Documenting business transactions provides a clear audit trail. Auditors and stakeholders rely on this documentation to verify the accuracy of financial records. It ensures transparency and accountability in the business's operations, reducing the risk of fraud, mismanagement, or errors. 4. Tax reporting. Accurate documentation of transactions is vital for preparing tax returns. Businesses must maintain records of sales, expenses, payroll, and other financial activities to comply with tax laws and to claim deductions or credits. Without proper documentation, businesses may face issues with tax authorities, resulting in penalties or audits. 5. Operational control. Having detailed records of business transactions allows management to monitor day-to-day operations efficiently. Documentation helps track inventory, payroll, sales, and expenses, ensuring that the business is running smoothly. This information can be used to make informed decisions about pricing, staffing, procurement, and other operational aspects. 6. Evidence in disputes. In case of disputes, whether with clients, suppliers, employees, or regulators, documented transactions serve as proof. For example, if there is a disagreement about payment terms, a written contract or invoice can resolve the issue. Well-documented transactions can protect the business from legal disputes by providing clear evidence of agreements and financial dealings. 7. Business decision-making. Documenting transactions allows businesses to gather accurate data, which is crucial for making strategic decisions. Detailed records help management analyze trends, forecast future growth, and make informed choices about investments, budgeting, and cost management. Reliable documentation forms the basis for sound business planning. 8. Facilitating loans and investments. Businesses seeking loans or investments need to provide financial documents to banks or investors. Properly documented transactions show the financial stability and performance of the company, helping it secure funding. Investors and lenders look at documentation such as financial statements, tax returns, and sales records to assess the business's potential. Importance of documenting business transactions. 1. Ensuring accuracy and reliability. Documenting transactions ensures that a business's financial information is accurate and reliable. Without proper documentation, it's difficult to verify financial figures, which can lead to incorrect conclusions about the business's performance or financial condition. Reliable records make sure all data is accounted for correctly. 2. Supporting business growth. Documented transactions allow businesses to track their growth over time. By maintaining records of revenues, profits, and expenses, a business can monitor its progress, identify patterns, and make decisions to encourage future growth. Documentation helps businesses understand what works and what doesn't, aiding in scalability and expansion. 3. Building trust with stakeholders. Documenting transactions builds trust with external stakeholders like investors, creditors, customers, and suppliers. Transparent and accurate records reassure stakeholders that the business is well managed and financially sound. It shows professionalism and accountability, which is crucial for maintaining strong relationships with key partners. 4. Risk management. Documenting business transactions is a key part of risk management. By keeping accurate records, businesses can quickly identify discrepancies, manage cash flow, and avoid financial shortfalls. It also helps in tracking obligations, such as payments owed to suppliers or debts to be collected, reducing the risk of financial mismanagement. 5. Compliance with regulatory bodies. Many regulatory bodies, including tax authorities, require businesses to maintain specific documentation. Not only does this ensure compliance, but it also provides protection in case of audits or investigations. Failing to document transactions properly can lead to penalties, regulatory action, or even legal challenges. 6. Long-term record keeping. Businesses need to retain transaction records for long periods for various reasons, including tax audits, financial analysis, and historical tracking. Well-documented transactions form the foundation for long-term record keeping and ensure that the company can retrieve necessary information years down the line when required. In summary, documenting business transactions is not just a matter of convenience. It is essential for legal, financial, and operational reasons. It enhances the accuracy, reliability, and transparency of a business, ensuring its smooth operation and growth while reducing risks. In the course of conducting business, numerous documents are generated between businesses and their customers. These documents can be broadly categorized into two distinct types: external documentation and internal documentation. Each serves a specific purpose within the organizational and transactional framework, ensuring both operational efficiency and compliance with legal and regulatory standards. We will now proceed to explain each type separately, providing a deeper understanding of their roles and significance within the business environment. External documentation in business transactions. External documentation refers to the records that flow between a business and external parties, such as customers, suppliers, and service providers. These documents serve as proof of the transaction, ensuring transparency and accountability on both sides. The amount and type of documentation required vary depending on the complexity of the transaction and the parties involved. To illustrate how external documentation works, let's walk through a scenario involving the installation of a central heating system. Scenario: central heating installation. Let's consider the process of having a central heating system installed in your home, from the initial inquiry to the payment. This will help explain each type of external document generated during the transaction. 1. Inquiry. Document. The first form of external documentation is the inquiry, which is generated when you contact the central heating company. This can be done via phone or written communication, letter, email. The purpose of the inquiry is to ask for information about the installation, and it sets the process in motion. Scenario: you reach out to the company to inquire about their services, either over the phone or by sending a letter or email, requesting details about the installation process. 2. Quotation. Document. After the inquiry, the next document is the quotation. A sales engineer visits your residence to assess the job and provides a quotation that outlines the estimated cost of installing the heating system. This is a formal document detailing what the company proposes to charge for the service. Scenario: once the sales engineer visits and evaluates your home, you receive a formal quotation in writing stating the price and scope of the work to be done. 3. Acceptance and acknowledgement. Documents. If you decide to proceed, the next document is your acceptance of the quotation. You may do this by sending a letter accepting the quote or by signing a more formal sales order document. The company will then send an acknowledgement confirming that they've received your acceptance and are ready to proceed. Scenario: after reviewing the quotation, you send a letter or sign the sales order giving the company the green light. In return, you receive an acknowledgement from the company confirming that they will begin work. 4. Delivery note. Document. Once the heating system has been installed, the company staff will ask you to sign a delivery note. This serves as proof that the system has been delivered and installed to your satisfaction. Scenario: after the installation is complete, the company asks you to sign the delivery note, confirming that the installation was done properly and that you have received the system. 5. Invoice. Document. After the job is completed, the company will send you an invoice. The invoice is a formal request for payment, detailing the amount owed for the service provided. If any overcharges occur, you may later receive a credit note to correct the invoice. Scenario: you receive the invoice, which outlines the total cost of the installation and the agreed upon payment terms. 6. Payment. Document. Once you've reviewed the invoice and the credit period has passed, you make the payment, typically by check or electronic transfer. This payment is an external transaction, and your check or payment record becomes part of the external documentation exchanged between you and the company. Scenario: after ensuring that everything is correct, you make the payment by check, completing the financial aspect of the transaction. 7. Receipt of payment. Document. Upon receiving your payment, the company ensures that the payment is processed and a record is made. Although this is primarily internal for the company, the confirmation or receipt of your payment also serves as part of the external documentation, especially for your records. Scenario: after your check is deposited, the company ensures it is recorded properly, completing the external documentation process on their side. Summary of external documentation. Starts the process. You ask for information or services. Quotation. Provides the cost estimate for the job. Acceptance and acknowledgement. You accept the quote and the company confirms receipt. Delivery note. Acknowledges completion of the service or delivery of goods. Invoice. Formal request for payment from the company. Payment. You make the payment to settle the transaction. Receipt of payment. Confirmation that your payment has been received and processed. Each of these documents plays a critical role in ensuring that both the business and the customer have a clear understanding of the services provided, the costs involved, and the terms of the transaction. In this scenario, the company must track each step through external documentation, which is essential for operational transparency, legal compliance, and customer satisfaction. Internal documentation in business transactions. Internal documentation refers to the records generated within a business to track, manage, and control its operations. These documents are crucial for maintaining smooth internal processes, ensuring that resources are properly managed, and enabling accurate reporting. While external documentation involves communication with customers or suppliers, internal documentation is used for coordination within the company. Let's continue using the example of the central heating company to explain the internal documents involved during a typical business transaction, such as installing a heating system. These documents ensure the company's internal workflow remains organized and efficient. 1. Purchase orders. Document. When the central heating company needs to buy parts or materials from other suppliers, it will generate a purchase order. This document specifies the parts required, quantities, and the agreed price with the supplier. Scenario. For example, if the heating system requires special components not in stock, the company will issue a purchase order to its supplier, initiating the internal process for ordering. 2. Inventory lists. Document. Inventory lists are used to check if all the necessary parts for the central heating system are available in stock. Each part is identified by a specific code number, allowing for efficient tracking of stock levels. Scenario. Before starting the installation, the company checks its inventory list to ensure all parts are available. If something is missing, they initiate the process to order the parts from suppliers. 3. Supplier lists. Document. A supplier list helps trace which supplier provides which parts. Each part's code number corresponds to a particular supplier, ensuring that the company knows where to source any additional materials. Scenario. If the heating system requires specific parts, the company consults its supplier list to identify the supplier responsible for providing those items, facilitating the purchasing process. 4. Staff schedules. Document. Staff schedules are used to allocate qualified engineers to various jobs. The company must ensure the right mix of staff is booked for each installation. Staff members record the actual hours they work on a timesheet for payroll purposes. Scenario. The company assigns engineers to the installation job and tracks their working hours using timesheets, which are later processed by the payroll system. 5. Goods received notes. Document. When parts ordered from suppliers are delivered, a goods received note is raised by the goods inward section to notify other departments that the materials have arrived. This document ensures that the inventory is updated and the parts are available for use. Scenario. Once the parts for the heating system arrive, the company generates a goods received note, confirming the delivery and updating its inventory records. 6. Invoices. Document. The company will receive an invoice from its supplier for the parts purchased. This invoice is used to update the company's accounting records, reflecting the amount owed to the supplier. If there is an overcharge or a return, a credit note may be issued to adjust the invoice. Scenario. After receiving the parts, the company gets an invoice from the supplier and enters the details into its accounts payable system, ensuring the amount is correctly recorded. Checks. Once the company has received the supplier's invoice, it will eventually make the payment by check or another form of payment. The check issued is documented as part of the company's payment system. Scenario. After reviewing the invoice and ensuring everything is correct, the company issues a check to the supplier as payment for the parts. 8. Expense claims. Document. Employees may incur additional expenses such as travel costs or purchasing small parts while working on a job. They will submit expense claims for reimbursement. Scenario. Engineers working on the installation may submit an expense claim for travel or other job-related costs, and the company processes these claims for reimbursement. Why internal documentation is extensive. The central heating company must deal with a significant amount of internal documentation for several key reasons. 1. Managing multiple transactions. The company handles numerous jobs at once, and each job generates a series of documents. To keep track of these, the company needs to organize and manage all documentation efficiently. This includes scheduling jobs, maintaining a record of parts used, and tracking payments. 2. Tracking payables and receivables. The company needs to maintain an accurate list of people who owe it money, customers, and those to whom it owes money, suppliers. The accounts payable system tracks outstanding bills, while the accounts receivable system monitors payments due from customers. 3. Cash flow management. It is essential for the company to ensure that it has enough cash at the right times to pay its bills, suppliers, and employees. Proper internal documentation, such as invoices and payment records, helps manage cash flow efficiently. 4. Profitability assessment. The company must continuously compare its earnings with its costs to ensure it is making a profit. Internal documentation, such as invoices, payroll records, and expense claims, provides the data necessary for this analysis. Role of the accounting system. The internal documentation generated through these transactions feeds into the company's accounting system, which serves several critical purposes. 1. Payroll system. The accounting system aggregates the hours worked by employees, recorded in timesheets, to ensure they are paid accurately. This system processes payroll for all workers involved in the installation. 2. Receivables and payables ledgers. The accounting system produces regular reports detailing who owes the company money, accounts receivable, and who the company owes money to, accounts payable. These reports help the company manage outstanding payments and obligations. 3. Cash and bank tracking. The system keeps track of the company's cash resources and bank accounts, ensuring that the company has sufficient funds available to cover expenses and payments. 4. Management reporting. At regular intervals, the accounting system generates reports that provide vital information to management. These reports summarize financial performance, helping management make informed business decisions. In conclusion, internal documentation is essential for the efficient operation of a business. It allows companies like the Central Heating Company to track resources, manage employees, ensure accurate payments, and monitor profitability. The accounting system ties all of this documentation together, ensuring that the business can operate smoothly and effectively. Hello students, and welcome to Lesson 5 from Chapter 1 of FIA FA1. In today's lesson, we're going to dive into some essential business documents and processes. We'll cover sales orders, understanding how businesses document customer orders, purchase orders, how companies formally request goods or services, invoices, the official requests for payment, credit notes, used to adjust the amount due for returned goods, debit notes, requests to adjust amounts upwards or downwards on transactions. E-commerce, exploring how online shopping is transforming the way we buy and sell goods. By the end of this lesson, you'll have a solid understanding of how these documents and processes work together in real-world accounting and business operations. If you find this lecture helpful, please like the video and subscribe to the channel to stay updated with more lessons. Your support means a lot. And if you have any feedback or questions, feel free to drop them in the comments below. I'd love to hear from you and help with any clarifications you need. Thanks for joining today, and let's get started. Sales order. Description. A sales order is a document generated by a seller when a customer places an order to buy goods or services. This document serves as a contract that outlines exactly what the customer is ordering, the agreed upon price, quantities, specifications, and delivery details. The sales order is crucial because it confirms the buyer's request and provides a clear record for the seller to fulfill the order accurately. This document ensures there is no confusion about the specifics of the sale for either party. Key components of a sales order. 1. Sales order number, a unique identifier for each sales order. 2. Customer information, includes the customer's name, contact details, and sometimes address for delivery. 3. Order date, the date the customer placed the order. 4. Order details, describes what the customer is buying, product name, model or SKU, quantity, and any options or customizations. 5. Pricing and taxes, lists the unit price, subtotal, any discounts, tax amounts, and total cost. 6. Delivery instructions, specific delivery date, location, and any special handling instructions. 7. Terms and conditions, may include payment terms, return policies, and warranties if applicable. Once the sales order is created, it acts as a binding agreement, meaning that the seller is responsible for providing the products or services as described. Purchase order. Description. A purchase order, PO, is a formal document created by a buyer, typically a business, to request goods or services from a supplier. The PO is sent to the supplier and acts as an official request for purchase, outlining all relevant details. It is legally binding, meaning the supplier is expected to deliver according to the terms specified in the purchase order. The PO helps the buyer manage their inventory and supplies efficiently, as it provides clarity on what, when, and how the supplier will deliver. Key components of a purchase order. Purchase order number, a unique identifier for tracking the purchase order. 2. Buyer's information, company name, address, and contact information. 3. Supplier information, vendor's name, address, and contact details. 4. Order date, the date the order was issued. 5. Item description and quantity, specifies what is being ordered with details like product name, model, or SKU, and quantity. 6. Pricing and payment terms, includes unit price, total amount, payment due date, or installment arrangements. 7. Delivery information, desired delivery date, shipping method, and location. 8. Terms and conditions, any additional agreements such as return policies, warranties, or penalties for delayed delivery. A purchase order becomes a formal commitment, as the supplier is expected to fulfill the order exactly as detailed in the PO. The buyer can use the PO to verify that the delivered items match what was ordered. Sales order sets. Sales orders often come with multiple copies, called sales order sets. This helps the seller track the order at each stage, from confirming the order with the customer to making sure the warehouse prepares and delivers the goods. Let's go through each copy and its purpose. Sales order copy, locations and purposes. 1. Copy 1, sent to the customer, confirming the order. Purpose. This copy goes to the customer to confirm that their order has been received and the details are correct. Example. Imagine a customer orders a custom heating system. Once they place the order, the seller sends them this copy to show that the order was received and includes details like the model, price, and expected delivery date. 2. Copy 2, sent to the warehouse, arranging delivery. Purpose. The warehouse receives this copy to start preparing the goods and arrange for delivery based on the details provided. Example. If a customer orders a heating system, the warehouse uses this copy to ensure the right model is packed and scheduled for delivery on the correct date. 3. Copy 3. Kept in sales department, handling customer inquiries. Purpose. This copy stays with the sales team, helping them address any questions or concerns the customer may have about the order. Example. Suppose the customer calls to check on the delivery status. The sales team refers to this copy to answer questions about delivery timing or order details. 4. Copy 4. Sent to accounts, generating the invoice. Purpose. This copy goes to the accounts department, who will use it to create an invoice for the customer. Example. When the order is shipped, accounts can refer to this copy to prepare and send the invoice to the customer for payment. 5. Copy 5. Sent with goods as an advice note for the customer. Purpose. This copy is attached to the goods, providing the customer with a summary of the order for their records. Example. When the heating system arrives, the customer receives this copy to confirm that everything matches what they ordered. 6. Copy 6. Sent with goods as a delivery note signed by customer. Purpose. Another copy goes with the goods as a delivery note, which the customer signs to acknowledge receipt. The seller keeps this signed copy as proof of delivery. Example. The delivery person presents this copy to the customer, who signs it to confirm they received the heating system. The signed copy is then kept by the seller. 7. Copy 7. Kept in warehouse, handling customer queries. Purpose. The warehouse keeps an additional copy to help answer any questions or handle issues related to the shipment. Example. If the customer reports that they received the wrong item or something was damaged, the warehouse can refer to this copy to double-check the order and manage purchase order sets. Just like sales orders, purchase order sets also come in multiple copies to help the buyer keep track of what they ordered. Each copy has a specific purpose to ensure that the purchasing, receiving, and accounting departments are all on the same page. Purchase order copy locations and purposes. 1. Copy 1. Sent to the supplier, placing or confirming the order. Purpose. This copy goes to the supplier to formally place the order or confirm a previous order made by phone or email. Example. Suppose ABC Heating Solutions needs heating system parts from XYZ Supplies. They send this copy to XYZ as an official order for the required parts. 2. Copy 2. Kept in purchasing department or warehouse. Purpose. This copy stays in the buyer's purchasing or warehouse department for easy reference. It's used to compare with the supplier's delivery and advice notes to make sure everything matches. Example. When the parts arrive from XYZ Supplies, the warehouse team checks the items against this copy to ensure they received the correct products and quantities. 3. Copy 3. Sent to accounts for matching invoices and goods received. Purpose. This copy goes to the accounts department, where it's used to verify the supplier's invoice and make sure the items have been received as ordered. Example. Once the goods are received, the accounts team matches this copy with the invoice from XYZ Supplies to make sure they're only paying for items that were delivered. Using sales order sets and purchase order sets in this structured way helps companies manage orders efficiently. It provides everyone involved with the right information to fulfill orders accurately, handle customer queries, and maintain clear records for invoicing and payments. An invoice is a document issued by a seller to a buyer requesting payment for goods or services provided. In essence, it serves as a formal demand for payment. Invoices are created whenever a transaction takes place where payment is due, whether immediately or within a specified time. What is considered a sale for one business is viewed as a purchase for the buyer, meaning both sides have different records but for the same transaction. An invoice typically includes detailed information about the items sold or services rendered, the agreed-upon prices, any additional charges or taxes, and the total amount the buyer needs to pay. Key details. Usually found on an invoice. An invoice generally contains the following important details. 1. Seller's information. This includes the seller's business name, address, and contact details. For example, in our sample, Chippy's is the seller with its address and contact number clearly stated. 2. Buyer's information. The invoice also lists the buyer's name and address. In our example, tabletops is the buyer, with their address provided to ensure clarity. 3. Invoice number. This is a unique identifier for each invoice. Every invoice has a different number to help the business keep track of all the invoices it sends out. For example, the invoice number is 13456, which makes it easy for both the buyer and seller to reference this specific transaction. 4. Date of issue. The invoice date shows when the invoice was created. This is important for tracking due dates and understanding when the transaction occurred. 5. Tax point time of supply. This is often the same as the invoice date and indicates when the sale took place for tax purposes. 6. Description of goods or services. The invoice details what items were sold or services were provided. For example, tables is specified on the invoice, so the buyer knows exactly what they're being charged for. 7. Quantity and unit price. The invoice shows how many units of each item were sold and the cost per unit. In the example, 30 tables were sold at $250 each. 8. Total amount. This includes the total price for the goods or services, along with any delivery charges or additional fees. 9. Sales tax information. If sales tax is applicable, the invoice will show the tax rate and the calculated tax amount, helping the buyer see how the total payment is derived. 10. Payment details. Instructions on how to pay, including any bank account details, are often included to make the payment process easier. Types or uses of invoices. Invoices can be used in different ways depending on when and how payment is required. Let's go through the main types of invoices to better understand their different uses. 1. Cash invoice, or receipt. When it's used. A cash invoice, often just called a receipt, is used when a transaction is settled immediately in cash. Example, suppose a manager pays cash for a business meal at a restaurant. The restaurant will provide a receipt as evidence of the expense. The receipt may include a note like, "Paid with thanks," indicating that payment was made in full at the time of the transaction. Purpose, it serves as proof that the payment was made right away, so there is no outstanding balance. Cash invoices are typically short and straightforward, as payment is already completed. 2. Cash on delivery, COD invoice. When it's used. A code invoice is used when the buyer is expected to pay upon receiving the goods. Example, a company purchases a new car and agrees to pay for it on delivery. The car dealership sends a COD invoice, and the payment is collected when the car is delivered. Purpose. This type of invoice ensures the seller receives payment at the time of delivery, reducing the risk of non-payment. It's often used in situations where the buyer and seller may not have an established credit relationship. 3. Credit invoice. When it's used. A credit invoice is used in transactions where goods are delivered, but the buyer is allowed to pay later, often within an agreed period, e.g. 30 days. Example, suppose a business receives a delivery of raw materials from a long-standing supplier. The supplier trusts the buyer and allows them to pay within 30 days. A credit invoice is issued to document the sale and the payment terms. Purpose. This type of invoice provides a record of the transaction and specifies when the buyer should make the payment. Credit invoices are common in business-to-business transactions where there is a credit agreement between the buyer and seller. Understanding invoices as receipts or credit documents. It's helpful to understand that while invoice often refers to a credit transaction where payment is due later, the term can also apply to immediate cash transactions. Therefore, invoices are not exclusively associated with credit. They may need to be settled right away, cash transactions, or after a period, credit transactions. Why is an invoice important? An invoice is more than just a request for payment. It's an essential document in business for the following reasons. 1. Record keeping. It provides both the buyer and seller with a record of the transaction, which helps in financial tracking and accounting. 2. Legal document. Invoices can serve as legal documents in case of disputes, as they confirm the agreement between the buyer and seller regarding payment terms, items sold, and total amount owed. 3. Tracking payments. With unique invoice numbers, businesses can easily track which invoices have been paid and which are still outstanding. 4. Tax purposes. Invoices document sales and taxes collected, making it easier for businesses to report accurately on tax returns. 5. Customer relations. Clear and detailed invoices reduce misunderstandings and provide customers with confidence as they know exactly what they're being billed for. By understanding the components and uses of an invoice, both buyers and sellers can handle transactions smoothly, maintain clear records, and ensure that payments are made accurately and on time. Let's break down and describe this sample invoice from Chippy's in detail. Here's what each part of the invoice means so it's easier to understand. 1. Header information. Seller details. The seller's business name is Chippy's. Their address is Woodhouse, Richmonds Road, London, SE1N 5AB. This information is important because it identifies who the buyer, in this case Tabletops, is dealing with and who is demanding payment. Invoice number. The invoice number here is 123456. This is a unique identifier for this specific invoice, making it easier for both the buyer and seller to track the transaction. Date. The date on the invoice is 0108X7. This represents the date the invoice was issued, which is important for record keeping and tracking when payment is due. Tax point. The tax point, or time of supply, is also dated 108X7. This indicates the date the transaction occurred for tax purposes, which is crucial for calculating when sales tax applies. Account number. This is the seller's reference account number, 3365, which may be used internally by Chippy's for customer account tracking. 2. Buyer and delivery information. Invoice 2. The buyer's details are labeled as Tabletops, located at 2 Peters Square, Wayford, Kent, CR2 2IA. This section identifies who is responsible for paying the invoice. Deliver to. Interestingly, this section also states same address, meaning that the delivery address for the goods is the same as the buyer's address. Sometimes businesses may have a different delivery address, but here, both are the same. 3. Contact and tax details. Telephone number. Chippy's contact number is 0171-123-4567, which buyers can use if they have questions regarding the invoice. Sales tax registration number. This number, 457-463519, is Chippy's tax registration identifier. It shows that Chippy's is registered to collect sales tax, and this registration number must be on invoices to comply with tax regulations. Bank details. The Northern Bank Code 20-2542 and account number 957023 are provided in case the buyer prefers to pay directly through the bank. This is common in business transactions as it simplifies the payment process. 4. Main body of the invoice. Order reference number. Your order number, 2490, helps Tabletops match this invoice with their original order, making it easier to track what they ordered. Item code. Each item has a unique code for identification. Here, 13579A refers to the tables that Tabletops ordered. This code allows the seller and buyer to refer to specific products more accurately. Description. A short description, tables, shows what is being purchased. Additional details can be included in this section, but tables is sufficient here as it matches the order. Quantity. The quantity ordered is 30 tables. This section shows how many units of the item the buyer requested. Unit price. The price per table is $250. Unit price is crucial because it helps in calculating the total cost based on quantity. Net amount. The total cost for 30 tables is calculated as $250 by 30, which equals $7,500. There's also a delivery charge of $100, making the total net amount for goods and delivery $7,600. 5. Invoice total summary. Sales value. The sales value of $7,600 represents the subtotal before sales tax is added. Sales tax. The sales tax rate is 17.5%. This sales tax is added to the subtotal, showing compliance with tax requirements. Amount payable. The total amount payable is the sum of the sales value and sales tax. 7,600 plus 1,330 equals 8,930. This is the final amount that Tabletops needs to pay to Chippies. 6. Understanding the importance of each section. Why use an invoice? An invoice is a formal request for payment from the seller to the buyer, documenting the items sold, their quantities, prices, and any additional charges or taxes. It serves as a legal document that the buyer owes this amount to the seller. Tracking with invoice number. The invoice number helps both the buyer and seller keep track of payments and identify specific transactions in their records. By breaking down the invoice, it becomes easier to see each element's role and understand how it helps both the buyer and seller keep records, track payments, and ensure all sales and purchases are documented accurately. Additional information, often found on invoices. Invoices can contain a variety of terms and phrases that clarify specific details about the payment, delivery, and other important aspects of the transaction. Here, we will break down some common terms and phrases found on invoices, explaining what they mean and providing examples to make them easier to understand. 1. Payment due date and terms of sale. The payment due date is the final day by which the buyer is expected to complete payment. Terms of sale refer to conditions set by the seller regarding when and how payment should be made. Example of net 30 days. The term net 30 days is often found on invoices to mean that payment is due within 30 days of the invoice date or delivery date, depending on the agreement. Imagine that Chippy's Furniture Co. issues an invoice to Tabletops Ltd. on March 1st with the term net 30. This means that Tabletops Ltd. has until March 31st to pay the full amount due on the invoice. If payment is not made by that date, it might incur late fees or penalties as stipulated by Chippy's Furniture Co. Other common terms. Net 15 days would mean payment is due 15 days after the invoice date. Due on receipt means that payment is expected immediately upon receiving the invoice. 2. Free on board. FOB stands for free on board, which refers to a shipping term often used in international trade. It tells both the buyer and seller who is responsible for paying transportation costs and when the risk for the goods transfers from the seller to the buyer. It can be broken down into two types. FOB shipping point, meaning in an FOB shipping point arrangement, the seller is responsible for all costs and risks until the goods reach the shipping point, like a port or warehouse. Once they reach this point, the buyer assumes responsibility for all transportation and delivery costs. Example, let's say Chippy's Furniture Co. is shipping tables to Tabletops Ltd. with the term FOB shipping point. Chippy's Furniture Co. will cover the costs of bringing the tables to the shipping port. But once the tables are at the port, Tabletops Ltd. will be responsible for all costs of transportation from that point, including shipping fees, insurance, and any other charges. Meaning, with FOB destination, the seller is responsible for all shipping costs and risks until the goods reach the buyer's location. Example, if the invoice says FOB destination, then Chippy's Furniture Co. will bear all costs to deliver the tables directly to Tabletops Ltd. This is common in scenarios where the seller has arranged full delivery to ensure the buyer receives the goods intact. 3. Tax point for sales tax point is the date at which sales tax becomes applicable to a transaction. It is used to determine when a sale is subject to tax and at what rate based on the applicable tax rate on that specific date. Example. Suppose Tabletops Ltd. buys tables from Chippy's Furniture Co. on March 1st. The sales tax rate is applied based on the tax point, March 1st in this case. If the tax rate was adjusted later, that change wouldn't affect this sale, as the tax is calculated based on the date the transaction took place. 4. Ex works. The term ex works refers to a situation where the seller makes the goods available at their premises, and the buyer is responsible for all transportation costs from that point onward. This term is frequently used in international trade, indicating that the buyer must arrange for and pay all shipping and delivery expenses. Example. If the invoice from Chippy's Furniture Co. to Tabletops Limited includes Ex Works terms, it means that Tabletops Limited would need to pick up the tables from Chippy's warehouse. From that point on, all expenses related to moving the tables, such as shipping fees, insurance, and handling costs, would be the buyer's responsibility. 5. E&OE, errors and E, errors and omissions accepted. The phrase stands for errors and omissions accepted. It is a disclaimer that allows the seller to correct any mistakes or omissions on the invoice after it has been issued, should they notice a discrepancy. Example: suppose Chippy's Furniture Co. accidentally lists the total amount on Tabletops Limited's invoice as $8,000 instead of $8,200. The E&OE phrase would allow Chippy's Furniture Co. to correct this mistake even after the invoice has been sent to Tabletops Limited. However, it's generally considered best practice for sellers to double-check invoices before issuing them, as frequent use of E&OE could damage trust between the parties. What is a credit note? A credit note is a document issued by a seller to reduce the amount a customer owes on a previously issued invoice. It acts as a way for the seller to adjust the outstanding amount, which can happen for various reasons, such as 1. Quality issues. The goods delivered might be damaged, defective, or not up to the expected quality. 2. Errors on the invoice. The original invoice may contain errors, like incorrect prices or quantities. 3. Partial return of goods. The customer might return part of the goods while keeping the rest. When a credit note is issued, it works like a negative invoice. Instead of creating a new invoice, the seller reduces the original invoice's total, and the buyer now owes only the adjusted amount. This allows both parties to keep a clear and organized record of their transactions without having to delete or replace the original invoice. How does a credit note work? A credit note is directly linked to the original invoice. When a seller issues a credit note, it reduces the total amount the buyer has to pay. For example, if the buyer originally owed $500 and the seller issues a credit note for $100, then the buyer will only need to pay $400. The credit note helps to keep everything in balance by adjusting the buyer's outstanding amount on the original invoice. When the payment is made, the buyer will only pay the net amount, the original invoice amount minus the credit note amount. Example: Paperchase Supplies and Tabletops Limited. To understand how a credit note works, let's look at an example where Paperchase Supplies issues an invoice and later a credit note to their customer, Tabletops Limited. The original invoice. On March 25, 2007, Paperchase Supplies issued an invoice. Invoice number 123678 to Tabletops Limited for office supplies. Here are the main details of this invoice. Goods, 200 units of a product called ring binders, identified with the code X12345Y. Unit price, each ring binder is priced at $2. Total goods cost, the total cost for the goods is $400. 200 units multiplied by $2 each. In addition, there is a sales tax, V8, applied at 17.5%, which amounts to $70 on the goods. Therefore, the total amount payable on the invoice is calculated as follows. Total goods cost, $400. Sales tax, $70. Total amount to pay, $400, plus $70 equals $470. This invoice serves as a request for Tabletops Limited to pay $470 for the items purchased. Issuing the credit note. After receiving the goods, Tabletops Limited raised a concern with Paperchase Supplies. Perhaps some of the ring binders were not satisfactory, or there was an error in the order. As a response, Paperchase Supplies issued a credit note on April 6, 2007 to adjust the amount Tabletops Limited needs to pay. The credit note number 245, contains the following details. Goods returned. Table returned 50 units of the ring binders. Unit price. The unit price remains the same at $2 per ring binder. Amount credited for goods. Since 50 units were returned at a unit price of $2, the total credited amount for the goods is $100. 50 units multiplied by $2 each. Sales tax. The credit note also adjusts the sales tax. At a rate of 17.5%, the VAT on the credited amount of $100 is $17.50. Thus, the total credit amount on the credit note is calculated as follows. Credit for returned goods, $100. VAT credit, $17.50. Total credit amount, $100 plus $17.50 equals $117.50. By issuing this credit note for $117.50, Paperchase Supplies reduces the total amount that Tabletops Limited has to pay on the original invoice. Calculating the new payment amount. Now, when Tabletops Limited prepares to make the payment to Paperchase Supplies, they will adjust the original invoice amount by subtracting the credit note amount. Here's the breakdown. Original invoice amount, $470. Less credit note amount, minus $117.50. Adjusted amount to pay, $470 minus $117.50 equals $352.50. Therefore, Tabletops Limited now needs to pay $352.50 after accounting for the credit note. Recording the payment. When Tabletops Limited finally makes the payment, they should ensure that they properly document this transaction to reflect both the original invoice and the credit note. On April 24th, 20X7, when they send the payment, they can follow these steps. 1. Record the invoice and credit note numbers. On the payment documentation, such as the check counterfoil or a payment record, they should note the invoice number 123678 and the credit note number 2045. This ensures that both documents are clearly referenced. 2. Stamp the invoice paid with the date April 24th, 20X7, indicating that payment has been made. 3. Stamp the credit note claimed with the same date, showing that the credit was used as part of the payment. By following these steps, both Tabletops Limited and Paperchase Supplies can keep a clear, accurate record of the transaction adjustments. Importance of credit notes. Credit notes are essential for maintaining accurate and transparent financial records. They allow sellers and buyers to adjust invoices without needing to delete or replace the original records. For buyers, credit notes help to track any deductions or adjustments in payment amounts, which is especially useful when there are returns, quality issues, or other adjustments needed. Debit note definition and purpose. A debit note is an official document issued to request or record an adjustment to a previously issued invoice. It's used in business transactions when there's a need to adjust the amount payable due to errors, overcharges, or returns. It acts as a formal request for a credit note from the other party, particularly when the original invoice amount needs to be corrected downward. When and why a debit note is issued. A debit note is issued in various scenarios. Each situation addresses a specific issue with the initial transaction, helping to keep both parties' accounts accurate and organized. Here are the main scenarios. 1. Debit note issued by the customer. In most cases, a debit note is issued by the customer to the supplier when the customer believes that the original invoice is incorrect. Common reasons for issuing a debit note from the customer's side include faulty or damaged goods. When goods are received but found to be defective, damaged, or not in the condition expected, the customer may request a reduction in the payment amount. This can happen, for example, if certain items are scratched, broken, or not functioning properly. Incorrect quantity delivered. If the supplier delivers fewer items than ordered but charges for the full quantity, the customer can issue a debit note to adjust the amount due. This document formally requests a reduction to match the quantity that was actually received. Errors in pricing. Sometimes, the supplier may mistakenly overcharge on an invoice. The customer might notice that a higher price was applied than agreed upon. In this case, the customer issues a debit note to request a correction in the price, ensuring that they pay the agreed amount only. Example scenario. Imagine that Company A orders 100 units of a particular product from supplier B. When the goods arrive, Company A finds that 10 units are damaged and therefore not usable. Instead of paying for the full 100 units, Company A issues a debit note to supplier B, specifying the need to reduce the total amount by the value of those 10 damaged units. The debit note thus serves as an official record, explaining why Company A will not pay the full amount, and it's a request for a credit adjustment from the supplier. 2. Debit note issued by the supplier. In certain situations, the supplier might issue a debit note to the customer. This typically happens when the supplier realizes that they undercharged the customer in the initial invoice. Reasons for a supplier to issue a debit note include undercharging on the original invoice. If there was an error in the initial invoice where the amount charged was lower than it should have been, the supplier might issue a debit note to adjust the amount payable upward. Additional services or goods provided. If the supplier provides extra services or additional goods that were not accounted for in the original invoice, they might issue a debit note to cover the extra cost. Example scenario. Let's say supplier B initially billed Company A for $500, but later realizes that the correct amount should have been $550 due to an oversight in pricing. Supplier B can issue a debit note for the additional $50, formally notifying Company A of the adjustment. This debit note explains the reason for the increase and updates the record for the final amount payable. Key components of a debit note. A debit note should be clear and detailed to avoid any misunderstandings. The typical elements in a debit note include debit note number, a unique reference number that helps both the sender and receiver track and organize the document for future reference. Date of issue, the date when the debit note was created, establishing when the adjustment was requested. Original invoice number, a reference to the original invoice that the debit note relates to, ensuring both parties can match the debit note with the initial billing document. Description of goods or services, details of the items or services in question, especially if they're being returned, found faulty, or if the quantity or price needs adjustment. Adjustment amount, the specific amount that the customer or supplier is adjusting, either adding to or deducting from the original amount. This ensures both parties are on the same page regarding the total value being disputed or corrected. Reason for adjustment, a clear and concise explanation of why the adjustment is being requested or issued. For example, 10 units returned due to defects, or correction in unit price due to billing error. Importance and role of debit notes in business. Ensuring accurate financial records. Debit notes help both buyers and sellers maintain accurate financial records. They serve as an official document to clarify adjustments, making sure both parties have the same understanding of the transaction details. Formal documentation for discrepancies. When there's an issue with an invoice, such as damaged goods or incorrect charges, a debit note provides formal documentation of the discrepancy. This can be crucial for avoiding disputes later, as it provides a clear record of what was requested and why. Enabling proper inventory and payment tracking. For companies managing large quantities of goods, debit notes assist with inventory control by tracking returns and discrepancies. The accounts team also relies on debit notes to verify the correct amount payable, preventing overpayment or underpayment. Facilitating communication between buyer and seller. Debit notes make it easier to communicate necessary adjustments formally. Both the buyer and the seller have an official document outlining the changes, making it less likely for miscommunication to occur regarding the payment amount or the reason for adjustments. In summary, a debit note is a vital tool in business transactions, providing a structured way to handle errors, returns, and adjustments in invoicing. It keeps financial records accurate, prevents misunderstandings, and fosters smooth communication between buyers and sellers, ensuring that each party is clear on the final terms of payment. Goods Received Note, GRN. Definition and purpose. A goods received note is an official document created by a company's warehouse or receiving department to confirm that goods ordered from a supplier have been received. It's an essential document in the purchasing and inventory management process as it helps to maintain accurate records of the quantities and condition of items received. The GRN acts as an internal record, confirming that the goods listed on the purchase order have arrived. It also allows the accounts department to match the goods received with the supplier's invoice before processing payment. When and why a goods received note is issued. A GRN is issued whenever goods are received from a supplier. It serves several important functions in the purchase and inventory process, including verification of goods. The GRN confirms that the quantity and quality of the goods received match what was ordered. It helps prevent mistakes by providing an official check against the purchase order. Inventory management. The GRN is used to update inventory records as it provides a record of goods that have been added to stock. This helps keep an accurate count of available products. Payment authorization. Before the accounts department pays the supplier, they need to confirm that the goods were indeed received as expected. The GRN acts as proof of receipt and allows the accounts team to cross-check the supplier's invoice with what was actually received. Internal communication. The GRN is also an internal document that helps departments within a company communicate. It informs the purchasing and accounts teams that the order has been received, preventing miscommunication between departments. Example scenario. Let's imagine that ABC Company orders 50 cartons of printer paper from a supplier. When the order arrives at ABC's warehouse, the receiving department checks each carton to ensure that all 50 have arrived and are in good condition. The receiving team then fills out a GRN, documenting the date, quantity, and condition of the goods, which is then shared with the accounts department. When the supplier's invoice is sent over for payment, the accounts team can use the GRN to confirm that everything ordered has indeed been received. Key components of a goods received. Note: a GRN typically includes detailed information to ensure clarity and accuracy. Key elements in a GRN number. A unique reference number that helps track the GRN in company records. Date of receipt, the date on which the goods were received. This helps in maintaining an accurate timeline for inventory records and payment processing. Supplier details, information about the supplier, including their name and contact information, which helps identify the source of the goods. Purchase order reference. The GRN usually refers to the original purchase order, PO number, allowing the receiving department and accounts team to easily match the GRN with the correct order. Description of goods. A detailed list of the items received, including product codes, names, and descriptions. This ensures that everyone reviewing the GRN can clearly understand what was received. Quantity received. The quantity of each item received, which is compared against both the purchase order and the supplier's invoice. If there is a discrepancy, such as fewer items received than ordered, this is recorded on the GRN. Condition of goods. Any issues with the condition of the goods, such as damages or defects, are noted here. This is important for quality control, as damaged items may need to be returned or replaced. Signature of receiver. The person who inspected and received the goods typically signs the GRN. This adds accountability, confirming that the person responsible has verified the details on the document. Importance and role of a goods received note in business. 1. Prevents payment errors. The GRN acts as a safeguard for the accounts department, helping them verify that payment is only made for goods actually received. By comparing the GRN with the purchase order and supplier's invoice, companies avoid paying for items that may have been invoiced but not delivered. 2. Ensures inventory accuracy. The GRN is a crucial document for keeping inventory records up to date. When goods are added to stock, the GRN is used to adjust inventory levels, which helps prevent stockouts and overstocking. 3. facilitates internal audits and accountability. The GRN creates a clear paper trail from the purchase order to the receipt of goods, making it easier to audit purchasing processes. It also adds accountability, since it requires a signature from the person who checked the goods. 4. Helps manage supplier relationships. GRNs play a role in managing relationships with suppliers. If there are frequent issues, such as incorrect quantities or damaged goods, the GRN serves as documented proof of the problem, allowing the purchasing department to negotiate better terms or request replacements from the supplier. 5. Documentation for discrepancies. If there is a discrepancy in quantity or condition of goods, the GRN documents the problem. This is useful for addressing issues with the supplier, such as requesting a replacement or adjusting the invoice. 6. Supports accurate financial reporting. By ensuring that only received goods are recorded in inventory and paid for, GRNs contribute to accurate financial reporting. They prevent overstating expenses in inventory, helping companies maintain realistic financial records. In summary, a goods received note, GRN, is an essential document in the purchasing process that records the receipt of goods, ensuring accurate inventory, supporting payment verification, and fostering smooth communication across departments. It helps keep financial and inventory records accurate, providing both verification and accountability. E-commerce, transforming how we buy and sell goods globally. What is e-commerce? E-commerce, or electronic commerce, is the buying and selling of goods or services over the internet. It has revolutionized traditional shopping by allowing transactions to take place entirely online, removing the need for face-to-face interactions or physical paperwork. With just a few clicks, you can now purchase anything from books and clothes to electronics and groceries right from the comfort of your home. The most significant benefit of e-commerce is its ability to connect buyers and sellers worldwide, enabling global trade on a scale that was once unimaginable. E-commerce and global access. One of the most exciting aspects of e-commerce is how it allows people to buy products from virtually any part of the world. For example, if you're living in Australia, you can easily buy a book published in the United Kingdom or the United States without ever setting foot outside your home. Just go to the website of an international retailer, choose the book, pay online, and it will be shipped right to your doorstep. This level of convenience and access was almost impossible before e-commerce. With e-commerce, geography is no longer a barrier. Whether it's a rare item, a limited edition product, or just something that's not available locally, e-commerce makes it easy to purchase products globally. This accessibility has significantly increased choices for consumers and has allowed small and large businesses alike to reach customers far beyond their local markets. How e-commerce streamlines documentation and processes. E-commerce has simplified not only the shopping experience, but also the documentation process for transactions. Traditionally, making a purchase involved multiple steps and a series of paper documents, like purchase orders, invoices, delivery notes, and payment receipts. In e-commerce, these steps are either fully automated or replaced by digital equivalents. Here's how e-commerce has streamlined various parts of the buying process. 1. Instant transactions and payments. With e-commerce, the entire transaction happens instantly. As soon as you make a purchase, payment can be completed through online methods like credit or debit cards, digital wallets such as PayPal or Google Pay, or bank transfers. This eliminates the traditional delay of waiting for an invoice, sending a check, or arranging other types of offline payments. 2. Digital invoices and receipts. Instead of receiving a paper invoice, customers receive a digital receipt or e-invoice immediately after completing their purchase. This electronic document includes all necessary details like item description, price, taxes, and payment confirmation. This e-invoice is instantly recorded in the seller's system, which reduces the need for physical storage and simplifies record keeping. 3. Order confirmations and tracking. After the transaction is complete, an order confirmation email is usually sent. This confirmation acts as proof of purchase and includes all the information about the order. Once the item is shipped, e-commerce platforms provide tracking information so customers can monitor their delivery status online. This is especially helpful for international purchases, as customers can see the item's journey across borders in real time. For automatic record keeping, e-commerce platforms automatically store each transaction in a digital ledger. This allows both customers and sellers to easily access past purchase records without sorting through paper files. For businesses, this digital storage makes it simple to manage inventory, analyze sales trends, and handle customer inquiries efficiently. 5. Reduced need for delivery notes and physical receipts. Traditional sales often required delivery notes to confirm that items had arrived. In e-commerce, delivery confirmations are sent digitally. For example, customers might receive an email or SMS notification that their item has been delivered. Some couriers even offer electronic proof of delivery through GPS tracking or digital signatures. This makes it easy to verify deliveries without relying on physical paperwork. Example, buying a book from an international seller. Imagine you're a student in India and you need a specific textbook that's only available in the UK. Here's how e-commerce makes it simple. You find the book on a UK-based retailer's website, add it to your cart, and complete the checkout by entering your shipping details. You pay for the book online using a credit card or digital payment option. Immediately after payment, you receive a confirmation email with details of your order and an estimated delivery date. Once the book is shipped, the retailer sends you a tracking link, allowing you to see where your package is in real time, even as it travels across international borders. Within a few days or weeks, depending on the shipping speed, the book arrives at your doorstep. This entire process, finding the item, ordering it, paying, and tracking it, takes just minutes and requires no physical paperwork. E-commerce has made it as easy to buy something from another country as it is to shop at a local store. Benefits of e-commerce documentation for businesses and customers. Time and cost efficiency. E-commerce eliminates the need for paper-based documentation, which saves both time and money. Businesses no longer need to print, store, or physically organize documents. 2. Improved accuracy. With automated systems, there is less room for human error in recording transactions. Every detail, such as price, item description, and payment information, is recorded digitally, ensuring accuracy and reducing the chances of mistakes. 3. Instant access to transaction records. Both customers and businesses can easily access digital records at any time. Customers can quickly retrieve purchase details or request returns, while businesses can track orders and manage inventory seamlessly. 4. Environmentally friendly. By reducing the need for paper, e-commerce contributes to environmental sustainability. The switch to digital documentation means fewer trees are cut down, and there's less waste from printed documents. 5. Enhanced customer experience. E-commerce platforms often provide features like instant refunds, easy return processes, and detailed FAQs, which improve the shopping experience. Digital documentation simplifies customer service and allows for faster, more efficient support. In summary, e-commerce has fundamentally changed the way we shop, making it possible for people to access goods from anywhere in the world with just a few clicks. By replacing traditional documentation with digital processes, e-commerce allows for faster transactions, greater accuracy, and a more streamlined experience. Whether buying a book from another country or ordering local groceries, e-commerce has made the entire process of purchasing, paying, and tracking orders easier, faster, and more accessible than ever before. This global reach and simplified documentation have transformed not just retail, but the entire landscape of buying and selling. Welcome, dear students. I'm thrilled to have each of you here today, joining us on this journey toward mastering the essentials of financial accounting. You've taken an incredible step forward in your studies, and I couldn't be prouder of your dedication and commitment to growing your knowledge. Today, we're diving into the 6th lesson from the FIA FA1 chapter, where we'll explore different types of discounts, rebates, and allowances. This lesson is all about understanding the various ways businesses incentivize transactions, from offering bulk purchase discounts to providing rebates for loyal customers. It's an essential topic, packed with practical insights that will truly empower your understanding of financial transactions and business strategies. As we go through today's lesson, please remember that your support means the world to us. If you find value in our content, please like this video and subscribe to the channel so we can keep bringing you the best study materials and guidance on your path to success. Let's get started and make today's lesson amazing. Let's dive deeply into discounts, rebates, and allowances, and explore how they work in business transactions. Discounts, rebates, and allowances are all ways in which sellers adjust the prices of goods or services. Specifically, we'll focus on 2 common types of discounts: trade discounts and cash settlement discounts. Each of these serves a different purpose, is applied at a different time, and has its own conditions. What is a discount? A discount is simply a reduction in the price of goods or services. It's a way for sellers to adjust prices, often to encourage more purchases or faster payment. When a discount is offered, the buyer pays less than the standard price that other customers might pay. Types of discounts. 1. Trade discount. A trade discount is a price reduction that is usually offered for reasons related to the business relationship or type of transaction. It's given directly on the supplier's invoice, meaning that the reduced price is calculated before the buyer receives the invoice. This type of discount is most commonly offered in 2 main scenarios. Buying in bulk. When a customer buys a large quantity of goods, the supplier might offer a trade discount to incentivize this larger purchase. For example, if an item usually costs $1 per unit, the supplier might reduce the price to 95 cents per unit if the customer orders at least 100 units at once. The supplier benefits by selling more at once, and the customer benefits from a lower unit price. Loyal or regular customers. Some businesses reward frequent or valuable customers with trade discounts as a way of recognizing their loyalty. Even if each individual order isn't large, the customer might receive a trade discount on every purchase because their overall spending with the supplier is significant. This type of discount can be a reward for long-term commitment or high cumulative purchases over time. Given on the invoice. The trade discount is shown directly on the invoice, reducing the price the customer is charged. Permanent reduction. Once it's offered, the trade discount doesn't depend on how quickly the customer pays. It's simply a price reduction based on the transaction type or relationship with the supplier. Example. Imagine a retailer purchasing office supplies. If they usually pay $50 per box of paper, the supplier might offer a trade discount that reduces the price to $45 per box if the retailer orders 50 boxes at once. This motivates the retailer to buy in larger quantities. 2. Cash settlement discount. A cash discount, also called a settlement discount, is offered to encourage the buyer to pay promptly. It's not based on the quantity of goods purchased or on being a loyal customer, but rather on how quickly the payment is made. Suppliers may offer a cash discount to improve their cash flow by receiving money sooner rather than later. How cash discounts work. Immediate or early payment. The discount is given if the buyer pays immediately or within a specified short period. The supplier sets specific terms indicating the discount percentage and the payment deadlines. Conditions for the discount. If the buyer doesn't pay within the time specified, the discount is no longer available. This means that the discount is withdrawn if payment isn't received on time. Example of cash discount terms. Suppose a supplier charges $1,000 for goods and offers a cash discount with these terms. 10% discount for immediate payment, meaning payment on the day of the invoice. 5% discount if payment is made within 7 days of the invoice date. No discount if paid after 30 days. Instead, the full amount is due within 30 days. If the buyer pays on the day of the invoice, they would only need to pay $900, benefiting from the 10% discount. If they pay within 7 days, they would pay $950 using the 5% discount. However, if they wait longer than 7 days, they would pay the full $1,000 because the discount terms have expired. Characteristics of a cash discount. Encourages prompt payment. It's a short-term discount meant to incentivize early payment. Removed if late. The discount disappears if payment isn't made within the specified time frame. Why is the difference between trade and cash discounts important? The distinction between trade and cash discounts is crucial because these two types of discounts are accounted for differently in financial records. Trade discounts. Since trade discounts are applied directly to the invoice, they reduce the sales amount up front. The buyer pays the discounted price from the beginning, so the original price doesn't even appear in the books. This discount is considered a straightforward reduction in the cost of goods. Cash discounts. Cash discounts are recorded as a separate financial transaction because they only apply when payment is made within a specific time. If the buyer misses the deadline, they pay the full amount, so the discount isn't guaranteed. When it is used, the cash discount is often recorded as a financial expense or reduction in income for the seller, reflecting the seller's intention to receive early payment. Key takeaway. Trade and cash discounts serve different purposes and are applied differently. Trade discounts are incentives based on the size or type of the order or customer loyalty and are permanent price reductions. Cash discounts, on the other hand, are rewards for prompt payment and are only available temporarily. Setting the scene. Ginger Spice and her 3 suppliers. Ginger Spice, a businesswoman, buys goods from 3 suppliers: Scary, Posh, and Sporty. Each of these suppliers offers discounts, but the discounts work in different ways. These discounts are either trade discounts, given for being a loyal customer or buying in bulk, or cash, or settlement discounts, given for paying quickly. Let's go through what each supplier offers. 1. Scary's discount. Scary provides Ginger with a trade discount. This discount is simple. Ginger gets a reduction in the cost of goods whenever she buys from Scary. Specifically, Scary offers a trade discount of 5% off Ginger's purchases. This discount is applied directly to her invoice, and it's a permanent reduction in price, which means it doesn't depend on when Ginger pays. She gets 5% off automatically as a customer, regardless of payment timing. 2. Posh's discount. Posh also provides a trade discount, but it's a bit more complex. The discount Posh offers only applies to amounts spent over a certain threshold. Specifically, Posh's discount is 7%, but this only applies to the amount over $100. So, if Ginger spends more than $100, only the portion above that amount receives a 7% discount. This type of discount encourages Ginger to spend a little extra because it only kicks in on the amount she spends beyond $100. 3. Sporty's discount. Sporty, the 3rd supplier, takes a different approach and offers cash or settlement discounts. These are based on how quickly Ginger pays. Sporty provides 2 options. If Ginger pays immediately, right when she makes the purchase, she gets a 10% discount. If she can't pay immediately but pays within 30 days, Sporty still offers a discount, but at a reduced rate of 5%. So, the faster Ginger pays, the larger the discount she receives. This approach encourages her to pay quickly, either on the spot or within a short time frame. Ginger's purchases in January. In January, Ginger buys goods from each of her suppliers, and she makes sure to understand the specific terms for each discount. 1. Purchase from Scary. Ginger purchases goods worth $400 from Scary. Since Scary's discount is a simple trade discount, Ginger automatically receives a 5% reduction on her total purchase amount. To calculate the discount, we take 5% of $400. So, $400 multiplied by 5% equals $20. This means Ginger saves $20 on her purchase from Scary due to the trade discount. 2. Purchase from Posh. Ginger also makes a purchase from Posh worth $700. Posh's discount only applies to amounts over $100, so the first $100 is not discounted. However, the remaining $600, $700 minus $100, qualifies for the 7% trade discount. To calculate the discount, we apply 7% to $600. $600 multiplied by 7% equals $42. Therefore, Ginger receives a $42 discount from Posh. Number 3. Purchases from Sporty. Ginger makes 2 separate purchases from Sporty. Let's go over each one. First purchase. For her first purchase, she spends $350 and pays immediately in cash. Because she paid right on the spot, Sporty applies the full 10% cash discount. To find the discount, we calculate 10% of $350. $350 multiplied by 10% equals $35. So Ginger saves $35 on this purchase because she paid immediately. Second purchase. Ginger's second purchase from Sporty is worth $700, but she doesn't pay immediately. Instead, she plans to pay within 14 days, which qualifies her for the 5% cash discount since it's within the 30-day period but not immediate. For this discount, we calculate 5% of $700. $700 multiplied by 5% equals $35. This means Ginger saves another $35 on this purchase due to the prompt payment. Adding up Ginger's total discounts. Now that we've reviewed each purchase and calculated each discount, let's summarize Ginger's total savings for January. 1. From Scary. Ginger saved $20 from the trade discount. 2. From Posh. Ginger saved $42 from the trade discount on the amount over $100. 3. From Sporty. Ginger saved $35 on her immediate payment and another $35 on her prompt payment within 30 days. To find the total amount Ginger saved, we add up all these discounts. $20 plus $42 plus $35 plus $35 equals $132. Summary of types of discounts received. To wrap up, Ginger received 2 main types of discounts. Trade discounts. These are the permanent price reductions she received from both Scary and Posh. Scary applied a straightforward 5% trade discount on her entire purchase, while Posh offered a 7% discount on the portion of her purchase over $100. Cash discounts. These are the discounts she received from Sporty for paying quickly. By paying immediately for one purchase, she received the maximum 10% discount. For her other purchase, she received a smaller 5% discount because she paid within 30 days, but not immediately. In total, Ginger's efforts to understand and use each supplier's discount terms helped her save $132 in January. This example demonstrates how understanding discount types can be beneficial for any business owner. 6.3. Accounting for trade discounts. A trade discount is a straightforward reduction in the price that a customer is required to pay for goods. This type of discount is typically offered to incentivize bulk purchases, encourage loyalty, or recognize a special business relationship. In essence, it's a permanent reduction in price and is applied directly on the invoice. How trade discounts work for the buyer and the seller. 1. When a business receives a trade discount. Imagine a business purchasing goods from a supplier who offers a trade discount. The amount the business is required to pay will be the normal price minus the discount. This means the supplier provides a price that already accounts for the trade discount, making it lower than the standard selling price. For example, if a business buys products worth $1,000 but receives a 10% trade discount, they would only be billed for $900. 2. When a business grants a trade discount, if a business sells goods to a customer and offers a trade discount, it reduces the amount they demand from the customer right on the invoice. The customer, therefore, only pays the discounted price. For instance, if a business sells goods worth $500 but provides a 5% trade discount, the customer would only be billed $475. Number 3. Calculating sales tax with trade discounts. If the sale is subject to sales tax, the tax amount is calculated on the discounted price. This means that the trade discount is deducted first, and only then is sales tax applied to the reduced price. For instance, if goods worth $1,000 are sold with a 10% trade discount and a sales tax of 5%, the discount would first reduce the price to $900. The 5% sales tax would then be calculated on this $900. 6.4. Accounting for cash discounts. A cash discount, also known as a settlement discount, is different from a trade discount because it is optional. It's offered to encourage quicker payments from customers and is based on financing policy, not regular sales or trading terms. Cash discounts received. When a business has the option to take advantage of a cash discount from a supplier, it's making a financing decision. The choice here is whether to pay sooner to receive a discount or to hold on to its cash for other uses and pay the full amount later. Example. Suppose Company A purchases goods from Company B with a standard 30-day credit period. The invoice amount for the goods is $2,000. However, Company B offers a 4% cash discount for immediate payment. Company A now has two choices. Option 1. Hold on to the $2,000 for the full 30 days and then pay the entire amount. Option 2. Pay the invoice amount minus the 4% discount immediately. This means Company A would only pay $1,920 if it chooses to pay right away. Here, Company A needs to decide whether it's worthwhile to save $80 by paying early or if it's better to use the $2,000 for other purposes over the 30-day credit period. This decision is about managing finances efficiently rather than obtaining goods at a reduced price. Cash discounts allowed. When a business offers cash discounts to its customers, it's also making a financing decision rather than a trading decision. Allowing cash discounts means giving customers the option to pay less if they pay sooner. The reasons a business might offer a cash discount include: 1. Early cash flow benefits. Receiving cash sooner can provide financial flexibility. For example, having cash on hand might allow the business to earn interest on it or reinvest it elsewhere. 2. Financial security. If the business is facing cash flow difficulties or wants to avoid potential bank charges or overdraft interest, getting some cash now, though it's less than the full amount, can help stabilize finances. 3. Customers' financial reliability. If the customer's financial health seems uncertain, accepting a smaller amount immediately might be safer than waiting for the full amount later, as it reduces the risk of the customer defaulting on the payment. In summary, cash discounts are a strategic financial choice rather than a sales tactic. They allow businesses to encourage quicker payments, which can enhance cash flow and reduce financial risk, depending on the business's priorities and the customer's payment reliability. This approach offers a structured view of how trade and cash discounts are applied in accounting. Trade discounts are straightforward, fixed reductions applied directly to invoice amounts, while cash discounts are conditional on early payment and depend on the financial preferences and priorities of both the seller and the buyer. Analysis of the question. The question is about calculating the total amount PayQuick, a company, needs to pay for goods after applying two types of discounts, a trade discount and a cash discount. Here's what we know from the question. 1. List price. The original price of the goods is $22,000. 2. Discounts offered. Trade discount of 10% on the list price. A trade discount is usually given to businesses to encourage bulk purchases or reward loyal customers. Cash discount of 2.5%, 2.5% if payment is made within 20 days. This discount is an incentive for quick payment, helping the seller improve cash flow. 3. tasks. Task A. Calculate how much PayQuick will pay if it does not pay within 20 days, and thus misses the cash discount. Task B. Calculate the amount PayQuick will pay if it does pay within 20 days and qualifies for both the trade and cash discounts. 4. Note, we are instructed to ignore sales tax in these calculations, which simplifies the problem by focusing solely on the discounts. Step-by-step explanation of the answer. Let's go through each part of the answer carefully to understand how these discounts apply and how the final amounts are calculated. Initial calculation. Applying the trade discount. The trade discount is the first discount to be applied to the list price. This discount is calculated as a percentage of the list price, $22,000, and is deducted to determine a reduced price. Step 1. Calculate 10% of the list price. Trade discount equals text list price times 10% equals $22,000 times 0.1 equals $2,200. Step 2. Subtract the trade discount from the list price to get the price after trade discount. Price after trade discount equals list price minus text trade discount equals $22,000 minus $2,200 equals $19,800. At this point, after applying the trade discount only, the amount PayQuick would need to pay is $19,800. Task. Amount payable if payment is made after 20 days. If PayQuick pays after 20 days, it does not qualify for the cash discount. This means the company will only benefit from the trade discount and no further reductions are applied. Amount payable in this case. Total amount payable equals price after trade discount equals $19,800. So, if PayQuick delays payment beyond 20 days, it will pay $19,800. Task B. Amount payable if payment is made within 20 days. If PayQuick makes the payment within 20 days, it qualifies for the cash discount. The cash discount of 2.5% is then applied to the price after trade discount, $19,800. Step 1. Calculate 2.5% of the price after trade discount. Cash discount. Price after trade discount times 2.5% equals $495. Step 2. Subtract the cash discount from the price after trade discount to get the final amount payable. $19,800 minus $495 equals $19,305. Therefore, if PayQuick pays within the specified 20-day period, it will pay a reduced amount of $19,305, benefiting from both the trade discount and the cash discount. Summary of the solution. Without the cash discount, if payment is made after 20 days, PayQuick pays $19,800. With both discounts, if payment is made within 20 days, PayQuick pays $19,305. Important points to remember. Order of discount application. The trade discount is applied first to the list price, and then the cash discount is calculated based on the price after the trade discount. Cash flow implications. By paying within the discount period, PayQuick not only benefits from a lower price, but also helps the supplier's cash flow, which is often the reason sellers offer cash discounts. By breaking down each step and understanding the sequence of discount applications, we can see how each type of discount impacts the final amount that PayQuick needs to pay. Understanding other types of discounts. Rebates and allowances. In addition to trade and cash discounts, businesses may be offered other forms of discounts as incentives to encourage bulk purchases, loyalty, or to prevent them from buying from competitors. These discounts, commonly known as rebates and allowances, provide unique benefits that differ from traditional price reductions. They are strategically used to improve customer loyalty and volume of sales, rather than to directly impact the immediate cash transaction. Here, we'll explore how rebates and allowances work their purpose, and offer clear examples to make these concepts easier to understand. Rebates, encouraging long-term spending. A rebate is essentially a form of post-purchase discount where a business receives a refund or partial repayment after purchasing a certain amount of goods or reaching a specific usage level. Unlike trade discounts, which reduce the upfront cost, rebates are given after the purchase is complete and usually after certain conditions are met. The goal of a rebate is to encourage long-term spending or usage by making it financially rewarding for the buyer. Key features of rebates. 1. Conditional. Rebates are usually contingent upon meeting a certain target, such as a minimum spending amount or usage level. 2. Delayed benefit. Unlike upfront discounts, the financial benefit of a rebate is realized only after the condition is met, often at the end of a specific period. 3. Flexible forms. Rebates can be given as a reduction in future costs or as a cash payout. Example of a rebate. Utility company rebate. Imagine a gas company offering a rebate to incentivize customers to use more gas. If a customer consumes over a specified number of units within a year, they qualify for a rebate. This rebate could be provided in one of two ways. 1. Reduced future bills. For the following year, the customer's monthly gas bills might be reduced by a certain amount, rewarding them for their higher usage. 2. Direct cash payment. Alternatively, the gas company may issue a check or direct deposit for the rebate amount, essentially returning a portion of the customer's spending as a reward. In this example, the rebate serves as a loyalty reward by reducing future costs or providing a financial refund, encouraging customers to continue using the company's services or products. Rebates are commonly used in utilities, manufacturing, and even consumer electronics, where buyers can receive a rebate if they purchase multiple units or exceed a specific amount of use. Allowances. Rewarding bulk purchases with extra goods. An allowance is another type of incentive discount, but functions differently than a rebate. Allowances are typically provided as additional units or products for free when a buyer purchases a specified quantity. They don't alter the price of each unit, but instead reward the buyer with extra goods, which increases the value of the purchase. Unlike rebates, allowances are given at the time of sale rather than at a later date, making them an immediate incentive for buyers to make larger purchases. Key features of allowances. 1. Immediate benefit. Allowances provide extra goods or units at the time of sale, increasing the quantity received without an additional cost. 2. Volume-based. Allowances are typically only offered for bulk orders, encouraging buyers to purchase more than they may initially need. 3. No impact on cash price. Since the buyer pays the same total price but receives more products, the allowance doesn't affect the total cash amount, but rather improves the per unit value. Example of an allowance. Retail allowance in a record shop. Suppose a record shop orders 50 compact discs, CDs, from a supplier. To encourage large orders, the supplier offers an allowance. If the shop orders 50 CDs, they will receive 5 additional CDs for free. So instead of receiving 50 CDs for the regular price, the shop receives 55 CDs for the same price as 50. In this scenario, the record shop gets more value for the same amount of money. Allowances are popular in industries where per-unit costs are low, and extra units can be easily given, such as in retail, food and beverage, and wholesale supply. Why rebates and allowances are used. Both rebates and allowances are commonly used marketing tools that offer indirect price incentives. Here's why companies might prefer these over traditional price reductions. 1. Encouraging larger orders. By offering an allowance, businesses incentivize customers to order in bulk. This can help companies achieve higher sales volumes and improve inventory turnover. 2. Building customer loyalty. Rebates encourage repeat purchases or long-term usage, making customers more likely to stick with a company over competitors. Since the benefit is often delayed, customers are incentivized to continue purchasing or using the product to qualify for the rebate. 3. Cash flow management. Rebates, since they are only provided after conditions are met, help suppliers maintain their cash flow while still offering financial incentives. Allowances, on the other hand, don't directly impact the cash price, making them beneficial for sellers who want to avoid immediate cash discounts. 4. Strategic cost management. Rebates and allowances don't reduce the immediate cash price, which means they can be applied without affecting the baseline unit cost. This can be useful for accounting purposes and allows businesses to maintain consistent pricing while still rewarding high volume or long-term buyers. Summary of key differences between trade discounts, rebates, and allowances. 1. Trade discounts. Direct upfront reduction on the sales price, applied on the invoice immediately. Commonly used for bulk orders or specific customer segments. 2. Rebates. Post-purchase discount applied after certain conditions are met. Offered as a future bill reduction or a cash payout, used to encourage long-term spending or usage. 3. Allowances. Extra goods provided free of charge when a specific quantity is purchased. Immediate benefit to the buyer, but does not affect cash flow directly, encourages bulk purchasing, and increases perceived value. By understanding these distinctions, businesses can decide when to offer trade discounts, rebates, or allowances depending on their goals, whether they aim to boost immediate sales, encourage larger orders, or foster long-term customer loyalty. Welcome, students, to Lesson 7 from Chapter 1 of ACCA FIA FA1. Today, we're diving into an essential topic, sales tax. You're making fantastic progress, and I want you to know that we're here to make every step of this journey as smooth and as straightforward as possible. I know studying for ACCA can sometimes feel overwhelming, but don't worry, we're in this together. We're committed to breaking down every concept so it's easy to understand, guiding you through each topic, and helping you feel fully prepared and confident for your exams. We'll be right here with you, all the way to the end of the book, ensuring you not only understand the material, but are ready to excel in your exam. If you're finding these lessons helpful, please show your support by liking this video and subscribing to our channel. Your support helps us bring you more high-quality lessons, and it lets us know we're on the right path together. Let's keep pushing forward, keep learning, and let's make passing this exam our goal, one lesson at a time. Let's get started with sales tax and make this topic crystal clear. Sales tax, an in-depth explanation. Sales tax is a type of indirect tax imposed by the government on the sale of goods and services. Unlike income tax, which is paid directly to the government, sales tax is collected by businesses at the point of sale and then forwarded to the tax authorities. This process ensures that the government earns revenue each time a product or service is sold. In business, there are two primary aspects to understand about sales tax: output sales tax and input sales tax. Output sales tax. Output sales tax is the tax a business charges its customers on the sale of goods or services. Essentially, whenever a business sells a product or provides a service, it includes an extra percentage as sales tax on top of the sale price. This additional charge is known as output sales tax. Input sales tax. Input sales tax is the sales tax that a business pays when it purchases goods or services from its suppliers. When a business buys materials, equipment, or other goods and services it needs, the supplier may add sales tax to the purchase price. This tax, known as input sales tax, is paid by the business to the supplier. This input sales tax can be seen as an expense for the business, but it also has another important role. In many jurisdictions, businesses are allowed to offset the input sales tax they've paid against the output sales tax they've collected. Sales tax in the European Union, EU. Sales tax operates under a similar principle across many countries, especially within the European Union, EU. However, each EU country can set its own sales tax rate, which can differ significantly from one nation to another. This rate variation depends on the government's policy, economic needs, and priorities. For example, the UK's sales tax is known as value-added tax, VAT. The rate for VAT can vary depending on the type of product or service. Basic necessities, such as some food items, might be taxed at a lower rate or even be exempt from VAT in certain cases. Luxury goods or non-essential items might have a higher VAT rate. Each country's tax rules are unique, and the rates are applied differently depending on product categories. Reduced rates. Many countries apply reduced rates on essential goods. These can include basic foods, medical supplies, and children's clothing. The purpose is to make these essential items more affordable for consumers by reducing the tax burden. Standard rates. Standard rates apply to most goods and services, covering a broad range of products. Higher rates. Some countries apply higher tax rates to luxury goods and services, such as jewelry, fine dining, or high-end electronics. These varied rates reflect government priorities and economic policies, as they aim to make essential goods affordable while taxing non-essential, higher-end goods at a higher rate. In the EU, businesses operating across borders within member countries must navigate these varying tax rates. This means they need to be aware of the specific sales tax requirements in each country where they sell products or services. The importance of sales tax rates in business calculations. For any business, accurately calculating sales tax is essential. The amount of tax charged to customers depends directly on the applicable sales tax rate. If a business miscalculates this rate, it can lead to significant issues, such as undercollecting or overcollecting tax from customers. In an educational setting, when studying sales tax in exams, students are often given a specific tax rate to apply in examples. This allows students to practice calculating the tax and understanding its impact on sales and pricing. It's crucial to pay attention to the provided rate because different rates will yield different tax amounts. And the purpose of the exercise is to understand how sales tax calculations impact financial transactions. In business practices, even small differences in tax rates can have significant financial consequences. For example, undercharging tax. If a business accidentally charges a lower tax rate than required, it will owe the difference to the government, leading to unexpected costs. Overcharging tax. Overcharging sales tax can lead to customer dissatisfaction and potential refunds, as customers have paid more than the legal requirement. Therefore, correct application of sales tax rates is essential for compliance, financial accuracy, and customer satisfaction. Record keeping and reporting. Sales tax businesses are required to keep detailed records of the sales tax they collect and pay. Accurate record keeping is essential because it allows businesses to track their tax liabilities accurately, report the correct amounts to tax authorities, provide documentation in case of an audit. Typically, businesses will include the sales tax amount separately on invoices, making it clear to customers how much of their total payment is due to sales tax. This transparency is important for both regulatory compliance and customer awareness. For reporting purposes, businesses submit periodic tax returns detailing the total amount of sales tax they've collected, output tax, and the amount they've paid, input tax. The difference between these two amounts is what the business either pays to or receives from the government. In summary, sales tax involves multiple components and considerations for businesses. Output tax represents what is collected on sales, while input tax represents what is paid on purchases. Businesses must apply the correct rates, maintain accurate records, and report regularly to comply with legal requirements. Understanding the mechanics of sales tax ensures businesses operate smoothly and comply with government tax laws. Calculating sales tax. Sales tax is an additional amount added to the original or net price of a product. This amount is typically calculated as a percentage of the net price. Let's go through the example provided. 1. Net price of the product. Here, the net price of the product is $120. 2. Sales tax rate. The sales tax rate is given as 20%. This means that the sales tax will be 20% of the product's net price. 3. Calculating the sales tax. To calculate 20% of $120, we multiply 120 by 20 and then divide by 100 to convert the percentage into a usable figure. The calculation is as follows. Sales tax equals $120 times 20 divided by 100. This equals $24. 4. Gross price calculation. The gross price of the product is simply the net price plus the sales tax. So in this example, gross price equals $120 plus $24, which equals $144. Thus, gross price is what the customer actually pays, and it always includes the net price plus sales tax. Ver 5, where the money goes. Purchaser pays the gross price, here, $144. Government receives the sales tax amount, here, $24. Seller retains the net price, here, $120 as revenue. 6. Reverse calculation from gross price. Sometimes you're given the gross price instead of the net price, and you need to determine the sales tax and net price from there. For example, if the gross price of a product is given as $282 and the tax rate is 20%, you can reverse the calculation. Sales tax equals gross price times 20 divided by 120. For $282, this calculation gives us $47 as the sales tax. Therefore, the net price would be gross price minus sales tax, which is $282 minus $47, resulting in $235. Part 2. The question and its solution. Now let's move on to the question. We are given two products, A and B. The gross price of product A is $705. The net price of product B is $480. The task is to determine the sales tax for each product if the sales tax rate is 20%. Solution. Let's solve for each product step by step. 1. For product A, since the gross price, the amount including sales tax, is $705, we want to calculate how much of this is the actual sales tax. Sales tax for product A equals 20 divided by 120 multiplied by 705. This calculation gives us $117.50 as the sales tax. So the net price of product A, amount excluding sales tax, is the gross price minus sales tax. Net price equals $705 minus $117.50, which equals $587.50. 2. For product B, we are given the net price for product B, which is $480. To find the sales tax, we take 20% of the net price. Sales tax for product B equals $480 times 20 divided by 100. This gives us $96 as the sales tax. So the gross price, amount including sales tax, of product B is gross price equals net price plus sales tax, which is $480 plus $96, equaling $576. Summary of key steps for clarity. Step 1. Identify if you're given the net price or gross price. Step 2. If calculating sales tax from net price, multiply by the tax rate divided by 100. Step 3. If calculating from gross price, multiply by tax rate divided by 120 to find the sales tax. Step 4. Use the result to either add to net price for gross or subtract from gross for net. This should clarify how sales tax calculations work, regardless of whether you're starting from the net or gross price. Following this approach will help you apply the right method based on the information provided. All right, let's dive deeper into the concept of input and output sales tax and examine each part of the table with clarity, as if I'm explaining this to beginner students who are new to this topic. Understanding input and output sales tax. In any business that buys and sells goods, sales tax plays an important role. Let's break down the basic concepts first before going into the table. 1. Output sales tax. This is the tax that a business charges to customers on its sales. Think of this as the tax that a business collects when it sells a product. For example, when a store sells a product to a customer, it might add a sales tax on top of the selling price. This sales tax amount is collected by the business but does not belong to it. It belongs to the government. 2. Input sales tax. This is the tax that a business pays to its suppliers when it buys products or services. When a business purchases goods or services necessary for its operations, it also pays sales tax on these items, which goes to the government. This tax is part of the business's expenses. How these taxes are balanced. At the end of a specific period, a business compares the total output sales tax it has collected from customers with the input sales tax it has paid to suppliers. If the output sales tax is greater than the input sales tax, the business has collected more sales tax than it has paid, meaning it owes the difference to the government. Conversely, if the input sales tax is greater than the output sales tax, the business has paid more in tax than it has collected, so it is eligible for a refund from the government. Now, let's go through the table step by step. Table explanation, detailed breakdown, output tax received, input tax paid. Total treatment. This table provides two scenarios showing what happens when output and input sales taxes are compared. Let's analyze each row in detail. Row 1. When output sales tax exceeds input sales tax. Output tax received, $1,000. This means the business has collected $1,000 in sales tax from its customers through its sales transactions. This amount represents the tax on the sales the business made during a specific period. Input tax paid, $900. Here, the business paid $900 in sales tax to suppliers for its purchases. This amount represents the tax the business incurred on the goods and services it bought to run its operations. Total, $1,000. Output minus $900. Input equals $100. The total here shows the difference between what the business collected sales tax and what it paid. Since the business collected more, $1,000, than it paid out $900, the result is $100. This extra $100 means that the business owes this amount to the government, as it represents additional tax collected from customers that the business hasn't spent. Treatment. Pay to government. Since the business collected more tax than it paid, this excess $100 needs to be paid to the government. The business acts as a collector on behalf of the government, so any extra amount collected in tax must be transferred to the government. Row 2. When input sales tax exceeds output sales tax. Output tax received, $900. In this case, the business has collected $900 in sales tax from customers through its sales. This represents the sales tax from the products the business sold within the period. Input tax paid. Here, the business has paid $1,000 in sales tax on its purchases. This is the tax the business paid to its suppliers on the products or services it purchased. Total, $900. Output, minus $1,000. Input equals $100. The total calculation here shows that the business paid out $100 more in sales tax than it collected. This negative result, represented by 100, indicates that the business has essentially overpaid in sales tax. Treatment. Refund from government. Since the business paid more in tax, $1,000, than it collected, $900, it is eligible for a refund of $100 from the government. The government will return this difference to the business because the business has effectively covered more in tax than it collected. Key points for clarity. Balancing act. The concept of input and output tax ensures that businesses only pay sales tax on the actual profit margin they earn from sales, not on every purchase. By deducting input tax from output tax, they only pay the tax owed after accounting for business expenses. Government's role. The government receives sales tax either directly, if output exceeds input, or indirectly through refunds, if input exceeds output. This balance helps maintain fair tax payments across businesses, avoiding double taxation on the same items. End of period adjustment. Businesses usually perform this input-output tax adjustment at the end of a tax period, monthly, quarterly, etc., to ensure they either pay or receive the correct amount from the government. This thorough explanation should clarify the mechanics of input and output sales tax, ensuring you understand how and why businesses adjust their taxes based on their collected and paid amounts. Hello, students. Welcome back to our journey in Lesson 8 of Chapter 1. Remember, you're not alone in this. We're right here, dedicated to guiding you every step of the way, helping you not just learn, but truly understand and master this so you can confidently pass your exams. Your support means the world to us. Please take a moment to like, share, and subscribe to the channel so that more students like you can join in and benefit. Let's keep pushing forward together toward success. What is information for a business organization? Information in a business context refers to the data and insights that are gathered, organized, and analyzed to help make decisions. This can include customer data, preferences, buying behavior; financial data, sales, revenue, expenses; market data, trends, competitors; operational data, inventory, supply chain status. Information allows a business to understand its performance, identify trends, anticipate risks, and make well-informed decisions. Think of it as the backbone that supports planning, strategy, and daily operations. 2. Importance of information storage in the modern era. With the rise of digital technology, the ability to store and manage information has become more critical than ever. Here's why. Easy access. Stored information is instantly accessible, enabling quick decision-making. Data analysis. Businesses can analyze stored data to gain insights into trends, customer preferences, and improve processes. Improved customer relations. Information on customer interactions can lead to better service and personalized experiences. Risk management. Stored information helps a business track performance and detect problems early. Regulatory compliance. Many businesses are legally required to keep records for audit and compliance purposes. Information storage is also important because it allows companies to innovate and stay competitive in a fast-changing market. 3. Consequences of not storing information or losing it. If a business fails to store its information or loses it, it can face several serious consequences. Loss of competitive edge. Without information, a business may lose its position in the market, unable to track or react to competitors' moves. Poor decision-making. A lack of data means managers have to rely on guesses rather than facts, increasing the likelihood of poor decisions. Customer trust issues. Losing customer data, especially sensitive information, can lead to a loss of trust and damage the business's reputation. Financial losses. Misplaced information can lead to financial reporting errors, legal issues, and even fines for non-compliance. Operational inefficiency. Without stored data, businesses may struggle with inventory management, supply chain issues, or customer service, which can disrupt operations. In today's era, where data is crucial, not storing or losing information can significantly harm a business's ability to thrive. Information management is not just a tool, but a lifeline for a successful and sustainable organization. Let's start by exploring the history of information storage and how it has evolved over time, especially in today's digital world where big data plays a huge role. 1. History of information storage. Early records. In ancient times, information was stored using primitive methods like cave paintings, clay tablets, and scrolls. For thousands of years, people stored important information on paper, using ledgers and handwritten documents to track finances, trade, and personal records. This process was slow, limited in space, and difficult to duplicate. The Industrial Age. The 1800s and early 1900s introduced advancements like the typewriter and filing cabinets, which allowed for more organized and efficient record keeping. But even then, information was mostly physical, making it prone to loss, wear, and damage. Early digital storage. In the mid-20th century, the invention of computers revolutionized information storage. Early computers used punch cards and magnetic tapes to store data. Over time, we moved to floppy disks, then hard drives, and later compact disks, CDs and DVDs, which could store more data in smaller spaces. The modern era, digital and big data storage. Today, with the rapid expansion of technology, we've entered the age of big data. Here's how modern information storage differs from traditional methods. Digital transformation. Most data today is stored digitally, meaning it's held in electronic form on servers, cloud storage, and databases, rather than on paper or physical devices. This allows massive amounts of information to be stored in relatively small spaces and accessed almost instantly from anywhere. Big data. With the rise of the internet, social media, IoT devices, and smartphones, businesses collect massive volumes of data, known as big data. Big data storage involves complex technologies that store, analyze, and manage vast amounts of data, which would be impossible to handle using traditional methods. Cloud storage. One of the biggest shifts in information storage is the cloud. Cloud storage allows businesses to store data in large server farms located in remote data centers. This means data is not tied to a single device or location, and it's highly scalable, secure, and accessible from anywhere in the world. Data lakes and warehouses. For big data, companies use specialized storage systems like data lakes and data warehouses. Data lakes store raw, unstructured data that can be analyzed later, while data warehouses store structured, processed data for easy access. These systems make it possible to store billions of records and analyze them quickly. How modern storage differs from traditional storage. Capacity. Traditional storage was limited by physical space, while modern digital storage can hold virtually unlimited data. Speed and accessibility. Today, data can be accessed instantly from anywhere, unlike traditional files, which required physical access and took time to retrieve. Data analysis. Modern storage systems are designed to work with data analysis tools. Unlike in the past, businesses can now use their data to predict trends, understand customer behavior, and gain insights automatically. Security and backup. Digital storage allows for encryption, regular backups, and secure storage options, providing far better protection than traditional methods could. Why information storage matters today. In today's world, where decisions are data-driven, modern storage is crucial for businesses to function, grow, and stay competitive. Access to big data allows companies to make informed decisions, personalize customer experiences, and innovate. In summary, the shift from traditional storage methods to advanced digital systems, including cloud storage and big data solutions, has completely transformed how businesses collect, store, and use information. This evolution not only allows for more efficient data management, but also provides the backbone for future innovation and strategic decision-making in today's digital world. All right, let's break down this concept of a company's retention policy and why it's important. Imagine that a business is like a busy marketplace. Every day, people come and go, buying and selling, and each of these transactions creates some kind of record or paperwork that needs to be saved. Now, if the business kept every single record forever, it would soon be buried in a mountain of papers. So, how does it decide what to keep and for how long? This is where a retention policy comes in. Understanding a retention policy. 1. What is it? A company's retention policy is a set of guidelines that says how long different types of information or documents should be kept. This includes everything from financial records, customer receipts, and employee information to contracts and legal documents. Think of it as a set of rules that tells the business when it's okay to throw something away or delete it, and when it should still be kept. 2. Why is it important? There are two main reasons why businesses need a retention policy. Security. Keeping unnecessary information around can create risks. For example, if sensitive customer information is kept for too long, it could be lost or stolen. Availability. The policy ensures that important documents are kept long enough to be available when needed. Imagine if a business had no record of its past transactions. It would be very difficult to check past accounts, settle disputes, or prove compliance with the law. Handling business paperwork. Every transaction a business makes generates some kind of paperwork, and this paperwork needs to be handled properly. This means organizing it, Information should be sorted and stored correctly so it can be found easily when needed. Storing it securely. Sensitive documents must be stored in a secure place, such as a locked file or an encrypted computer system. Ensuring access. The right people should have access to the information, but it should be protected from anyone who doesn't need to see it. In short, a company's retention policy is like a roadmap that tells the business which information to keep, where to store it, and when it's okay to let it go. This not only keeps the business running smoothly, but also protects it from risks and ensures it's ready to respond whenever information is needed. In any business, managers constantly need information to make informed decisions, plan ahead, and keep operations running smoothly. Let's look at the 4 main types of information they often require and why each one is so valuable. 1. Records of past and current transactions. What this means. This type of information includes details of every transaction or business activity, like sales, purchases, or payments that have happened over time. These records might still be in process, awaiting confirmation, or already completed but stored for future analysis. Why it's needed. Managers often need to confirm that transactions were handled correctly, or look back at these records to understand past business activity. Example. Imagine a clothing store that keeps records of every item sold. These records help the manager know which products were popular last season and which weren't. If a manager sees that blue jeans sold more than any other item last season, they might decide to stock up on them again in preparation for the next season. 2. Information on past trends and current operations. What this means. This information helps managers understand patterns from the past and the current status of business activities. It's used as a foundation for planning future actions and making decisions. Why it's needed. Managers use trends to predict what's likely to happen in the future, and they adjust operations accordingly. This type of information helps them avoid shortages or excesses in inventory and ensures that operations are efficient. Example. Let's say a manufacturing company looks at how quickly its raw materials, like metal or plastic, are used up each month. By understanding the past rate of consumption, they can plan ahead for future orders. If they know they go through 100 pounds of plastic each month, they'll make sure to order enough each month to avoid delays in production. 3. Routine transaction information for current operations. What this means. This is the day-to-day information needed to carry out ongoing tasks. It includes all the details required for routine activities, like processing customer orders and restocking inventory. Why it's needed. Routine transaction information helps managers and staff make quick, accurate decisions on a daily basis to keep operations flowing. Example. In a warehouse, if a customer orders 50 units of a product, the manager needs to know how many units are available in inventory, when they can be shipped, and how they'll be paid for. This information ensures that the order is fulfilled on time and that the correct payment and delivery arrangements are made. Information on performance for comparison and control. What this means. Managers need performance data to compare actual results with the company's plans, budgets, and forecasts. This information allows them to check for any discrepancies and make corrections where necessary. Why it's needed. Monitoring performance helps managers control operations by identifying areas that are off track. If something is underperforming, they can take corrective action to address the issue. Example. Suppose a company budgeted $10,000 for advertising this month, but actually spent $12,000. This difference might indicate overspending, and the manager could investigate why costs were higher than planned. This control function allows the manager to keep spending in line with the budget or make adjustments to improve efficiency. Bringing it all together. In summary, a business organization has a constant need for information because it allows managers to verify past transactions and ensure accuracy, understand trends to plan future inventory or production needs, make daily operational decisions based on up-to-date transaction data. Track performance against targets and budgets, making adjustments to stay on course. Each type of information serves a unique role in keeping the organization on track, and without access to accurate information, it would be difficult for managers to make the best decisions for the company's growth and stability. Let's explore who outside of an organization needs information from it, why they need it, and how this benefits both the organization and these external parties. For a business to operate smoothly and successfully, it often needs to share certain information with people and groups outside of its own employees and managers. This is not only a matter of transparency, but is often required for efficient, ethical, and legal operation. Here are the main external groups who need information from a business. 1. Other parties involved in transactions, customers, suppliers, and subcontractors. Who are they? These are groups that the business directly interacts with for its operations. Customers buy products or services from the business, suppliers provide the raw materials or products the business needs, and subcontractors might handle specific parts of the business's work. What information do they need? Customers often require information about their orders, delivery details, and payment options. Suppliers need to know about purchase orders, delivery dates, and any special requirements for the goods they supply. Subcontractors need clear instructions and deadlines on what they are supposed to do, whether it's delivering a product or completing part of a project. Example: imagine a construction company working on a big project. It orders building materials from a supplier and contracts electricians, plumbers, and other subcontractors. The company must provide accurate information about the project timeline and specific materials needed so that the contractors and suppliers can fulfill their roles correctly. Any mistake or delay in sharing information could lead to costly project delays or errors. 2. Parties interested in financial performance: shareholders, investors, and accounts payable. Who are they? Shareholders, people who own shares or stocks in the company. They're part owners of the business and have a right to know how well the company is performing. Investors, people or entities considering putting money into the business. They need reliable information to decide if the business is a good investment. Accounts payable, banks, creditors, or anyone else the business owes money to. They need to know the company's financial health to ensure it can repay its debts. What information do they need? Shareholders and investors often look at financial statements like profit and loss accounts and balance sheets to see if the company is profitable. Creditors may require detailed financial information to assess the risk of lending more money or to set the terms of repayment. Example: if a manufacturing company wants to expand, it might need additional financing from investors. These potential investors would want to see accurate financial reports that show the company's current revenue, profit margins, and growth potential before deciding to invest. If the business isn't transparent, investors may hesitate, fearing the risks of investing in an unknown financial situation. 3. Outside agencies, government bodies and tax authorities. Who are they? Government departments, regulatory agencies, and tax authorities that monitor business activities to ensure compliance with laws and regulations. What information do they need? Government bodies may require data for economic surveys, environmental impact assessments, or industry compliance. Tax authorities need financial data to assess the company's tax obligations. Example: suppose a company operates in an industry that produces emissions. Regulatory bodies might need regular reports on the company's emissions to ensure it complies with environmental standards. Additionally, every year, the company must submit accurate tax reports to tax authorities. Failure to provide this information could result in fines or legal action. Bringing it all together. In essence, sharing information with these external parties is vital for several reasons. It builds trust and enables smooth transactions with customers, suppliers, and contractors. It ensures accountability to investors, shareholders, and creditors who rely on transparent financial performance to make informed decisions. It maintains compliance with government and regulatory bodies, which is crucial for legal operation and avoids penalties. Without effective communication with these external groups, a business risks operational delays, financial setbacks, or even legal trouble. By providing the necessary information, the organization can maintain strong, reliable relationships with each group, ensuring mutual benefit and stability. Let's go through this text in detail, focusing on understanding each point thoroughly and how it applies in a business or organization setting. 1. Personal or interpersonal information for inquiries and complaints. What this means. This refers to the type of information exchanged directly between individuals when dealing with inquiries, requests for information, or complaints. When people have questions, complaints, or specific issues, they need clear, direct responses. This might include personal introductions, explanations about products or services, apologies if there was a mistake, and answers to questions. Why it's important. Interpersonal communication is crucial in handling inquiries and complaints, as it creates a sense of understanding and respect between the organization and the people it interacts with. This approach helps build trust and can resolve issues effectively, making customers or colleagues feel heard and valued. Example. Imagine a customer who bought a laptop that doesn't work properly. They call customer service to complain. The customer service representative introduces themselves, listens to the issue, explains what might have gone wrong, apologizes for the inconvenience, and offers a solution, like arranging for a repair or replacement. This kind of personal interaction helps solve the customer's problem and leaves a positive impression of the company's support. 2. Information provided by an employee about themselves. What this means. This includes all the personal information an employee shares with the organization, especially during hiring. It could be in the form of a job application, resume, curriculum vitae, or during interviews. Once hired, this information is stored in the organization's records for reference and administrative purposes. Why it's important. Employee information is essential for various reasons, like determining qualifications for the role, creating a record for legal and HR purposes, and ensuring that the organization can contact or support the employee if needed. This information is also critical for tracking employee history and performance. Example. When an individual applies for a job, they provide details about their education, work experience, and skills in their resume. If they're hired, this information becomes part of their official employee record, which HR uses for managing payroll, benefits, and performance evaluations. If the employee later applies for an internal promotion, the organization can quickly check their qualifications based on these records. 3. Information provided to employees about the organization. What this means. This includes all the information that the organization shares with its employees to help them understand the company's operations, their role within the system, and any updates or changes. It might be provided through training, documents like employee handbooks, internal memos with important updates, or regular staff meetings. This is usually part of onboarding, also called induction, when employees first join the company. Why it's important. Informing employees about the organization and their role helps them feel more comfortable and prepared in their job. It provides clarity about expectations, introduces them to the company's culture and goals, and can motivate them by showing their place within the larger structure. Example. A new employee at a manufacturing company might attend an induction session where they're introduced to the company's history, goals, and safety procedures. They might also receive a training manual with instructions on how to operate certain machines. Regularly, the company may send out memos to update employees on safety protocols or hold meetings to discuss productivity goals. This keeps employees aligned with the company's objectives and helps them understand how they contribute to its success. Bringing it all together. Personal or interpersonal information exchanges are essential in a business because they enable smooth operations and foster trust and communication between different parties. Each type of information serves a unique purpose. Direct communication for inquiries and complaints helps resolve issues and strengthens relationships with customers and colleagues. Employee-provided information allows the organization to understand and manage its workforce effectively. Information given to employees ensures they are well prepared, motivated, and aware of their responsibilities within the company. Each of these interactions plays a key role in ensuring that the organization runs smoothly, employees are supported, and customers feel valued. Let's go through each type of information handled in an accounts department to understand why it's critical for smooth operations, legal compliance, and effective financial management. 1. Incoming correspondence. Explanation. Incoming correspondence refers to all types of communication coming into the accounts department from people or entities outside the organization, including letters, emails, memos, and reports. These could be from clients, suppliers, government agencies, or other departments within the same organization. Purpose. This information is handled and stored to ensure action. The department needs to act on certain messages, responding to inquiries, completing transactions, or providing information as requested. Analysis. Some correspondence may need to be analyzed to understand its implications on the company's financial health, like a request for bulk orders, which would impact inventory and cash flow. Confirmation. Incoming correspondence serves as proof of communication received from outside parties, providing a record of claims, requests, or obligations. Example. Suppose a supplier emails the accounts department to confirm an order and send an invoice. This email needs to be stored to ensure the accounts team has a record of the transaction terms, the total amount, and payment deadlines. If there's a dispute later, say over payment terms or quantity, the team can refer back to the stored correspondence to clarify the agreement. 2. Outgoing correspondence. Explanation. Outgoing correspondence includes emails, letters, memos, reports, or any documents the accounts department sends out to other departments or external entities. This could include responses to supplier queries, payment confirmations to vendors, or internal memos. Purpose. Outgoing correspondence needs to be managed and stored to serve as evidence. Keeping copies of outgoing communication provides proof of what the organization or department has communicated. This is critical if questions arise about what was agreed upon or instructed. Provide confirmation. Stored outgoing correspondence confirms that specific instructions, payments, or responses were sent, helping avoid any miscommunication. Example. If the accounts department sends an email to a client confirming that their payment was received, this email should be stored. Later, if the client claims they didn't receive confirmation, the accounts team can easily retrieve this stored email as evidence that the confirmation was indeed sent. 3. Financial records. Explanation. Financial records are all the documents generated or received as part of transactions and reporting. This includes invoices, receipts, ledgers, payroll records, and financial statements. These records form the backbone of financial data in any organization. Purpose. Financial records are stored and managed to aid in planning and control. Access to financial records allows the department to review past transactions, budget accurately, forecast cash flow, and manage expenditures. Meet accountability requirements. External agencies, such as tax authorities, regulatory bodies, or auditors, require organizations to keep accurate financial records for compliance purposes. Legislation often mandates the storage of these records for a specified period. Example. If the accounts department processes payroll, they generate records showing salaries, deductions, and net pay. These records need to be stored securely because they're essential for managing budgets, planning future payroll expenses, and providing proof of payroll compliance during audits. Additionally, if an employee has a question about their pay, the accounts team can refer to these stored records to clarify. Bringing it all together. Each of these types of information, incoming correspondence, outgoing correspondence, and financial records, has distinct roles in supporting an accounts department's efficiency, legal compliance, and financial control. Incoming correspondence allows the department to track requests and interactions with outside entities. Outgoing correspondence ensures that the department has records of communications sent, protecting the company from potential disputes. Financial records support accurate financial planning and control while ensuring compliance with legal and regulatory standards. Example for all three types together. Imagine an accounts department receiving an email, incoming correspondence, from a supplier with an invoice for a recent bulk purchase. The accounts department then sends a confirmation email back to the supplier, outgoing correspondence, after processing the payment. The invoice, payment confirmation, and all records of this transaction, financial records, are stored together. This organized storage provides a complete record of the transaction, ensuring clarity, protecting against disputes, and helping with future planning. Each type of information requires specific handling and secure storage, ensuring both the department's efficiency and the company's long-term financial stability. Retention policy, understanding the types of files and their storage. In an organization, data and information are managed in a structured way, especially when it comes to file retention. These files are categorized based on how long they should be kept and how frequently they are used. The retention policy helps determine which files are permanent, temporary, active, or non-active. Below is a detailed breakdown of each category with examples to make it easier to understand. 1. Master files and reference files, permanent files. Explanation. These are files that store essential foundational information that the organization needs to keep indefinitely. These files are never thrown away because they contain critical data that supports ongoing operations. Purpose. These files are updated over time, but the files themselves remain part of the company's records. They act as a reference for many operations in the future. Examples. Customer master file. This file contains information about all customers, e.g., name, address, contact details, credit history. Even though a customer's contact information may change over time, the customer's file will continue to exist and be updated. This allows the company to track historical interactions and maintain a complete record of the customer. Employee master file. This file holds personal data of employees, e.g., name, address, employment history, salary details. This file stays with the company even after an employee leaves, as it may be needed for legal reasons, e.g., tax reports or pension plans. Why permanent? This is because the information in these files is foundational and often has legal or regulatory requirements that necessitate long-term retention. Even though the information may change, like a customer's address, the file itself continues to hold value over the years. 2. Temporary or transitory files. Explanation. Temporary files are used for short-term storage. They usually hold data or records related to specific transactions or activities that are only needed for a short period before they are discarded. Purpose. These files typically serve a single purpose during a transaction and are not required for future reference once the task is completed. Examples. Receipt files. These are temporary files that store receipts for purchases made during the year. Once the receipts have been processed into the accounts and the financial reports are finalized, these files may be discarded. Project-specific files. For instance, if an event is held, files with planning documents, emails, and other event-related data may only be kept for the duration of the project. Once the event is over, the file is no longer needed and is scrapped. Why temporary? These files are generally not needed once the transaction or event they relate to is finished. For example, a project that was completed months ago doesn't require ongoing records once all expenses and payments have been processed. 3. Active files. Explanation. Active files are files that are frequently accessed and used on a daily basis. These files are essential for current operations, and their data is regularly updated to reflect ongoing business activities. Purpose. Active files are used to manage and monitor the company's day-to-day operations, and they must be readily accessible because they contain current, up-to-date information. Examples: sales invoice files. These files contain invoices for products or services sold during the current financial year. Sales teams or accountants may need to access these files frequently to process payments, resolve disputes, or track sales progress. Customer correspondence files. This could include emails, letters, or contracts with current customers. These files are often accessed for quick responses or to review agreements. Why active? These files are in constant use because they pertain to ongoing business transactions. For instance, invoices are processed regularly, and customer correspondence needs to be tracked to maintain relationships and ensure smooth business operations. 4. Non-active files. Explanation. Non-active files are those that are no longer in regular use. These files may contain outdated or obsolete information, but they still have some value. They are kept for reference or legal reasons, even though they are not frequently accessed anymore. Purpose. Non-active files are typically stored for historical records, compliance with legal obligations, or other long-term purposes. They may be referenced occasionally, but are not part of the daily workflow. Examples: old customer files. This could include records of customers who no longer do business with the company. Even though no new transactions are taking place, the information may be kept in case of future legal inquiries or customer reference needs. These are files containing tax documents from previous financial periods. The tax authority might still request them for audits, but they are no longer used in daily operations. Why non-active? These files are no longer required for daily activities, but may be needed for future reference or compliance. For example, old tax returns may be required for auditing purposes, even though they're not relevant to current operations. Semi-active files. Explanation. Semi-active files are files that are on their way to becoming inactive. These files are not used regularly anymore, but still have ongoing relevance or could be needed for reference in the near future. Purpose. These files may not need to be accessed every day, but they should be stored and easily retrievable if needed for special situations or specific queries. They may still hold value, but are gradually becoming obsolete. Examples: contracts near completion. If a contract is nearing its end, the associated files may not be accessed frequently, but they should be kept on hand in case a dispute arises or for future reference. Past financial year data. As the financial year concludes, some files related to the previous year's accounts may no longer be used on a daily basis, but could be referred to for analysis, tax purposes, or comparison with the new year. Why semi-active? Semi-active files are in transition. They may be less frequently used, but they still hold value as they might be referenced in specific situations, like analyzing past trends or resolving issues that were raised earlier. Why this categorization matters. The categorization of files, permanent, temporary, active, non-active, and semi-active, helps organizations manage their information effectively. By identifying the type of file, an organization can determine how long to keep. It ensures that only necessary files are kept for extended periods, while unnecessary files are discarded in a timely manner. How to organize. It helps decide how to store files, e.g., physical storage, cloud storage, or database management, based on their frequency of use. Compliance ensures the company is compliant with legal or regulatory retention requirements, e.g., financial records that must be kept for a certain number of years. Example for all categories. Let's say a company has a customer master file, permanent, that contains a list of all clients and their details. While that file remains permanently in the system, there may be an order transaction file, temporary, for a one-time order from a customer that will be scrapped once the order is complete. The company will keep current year sales invoices active in one folder, while older customer files, non-active, will be archived and kept for reference. Lastly, a contract nearing completion might be placed in a semi-active file where it's kept for occasional reference, but not accessed daily. By organizing data in this manner, businesses can ensure they manage their information efficiently, save resources, and comply with necessary regulations while maintaining a clear, accessible record system. Handling information that is no longer needed on a daily basis. When information contained within files is no longer needed on a daily basis, organizations don't automatically throw them away. Instead, they adopt one of the following practices to manage these records. This process ensures that important information is preserved in a systematic way, either for future reference, compliance, or for historical reasons. The three main methods for handling files that are no longer actively needed are 1. Microfilming or microfiching for long-term storage. Explanation. Microfilming and microfiche are techniques for creating miniature photographic versions of documents, allowing large amounts of information to be stored in a very small space. These forms of storage are often used for documents that need to be preserved for long periods but aren't regularly accessed. Purpose. These methods are useful for storing historical documents, legal records, or any files that must be kept due to legal, regulatory, or archival requirements, but are unlikely to be referenced frequently. Example: legal contracts. A company might have signed contracts that are no longer relevant to day-to-day operations, but must be kept for a certain number of years for legal reasons, e.g., contracts related to partnerships, patents, or financial agreements. Instead of keeping physical copies that take up space, the company might microfilm these documents. By storing them in a compact form, they can be easily retrieved in the future if needed, without requiring a lot of storage space. Historical records. Government agencies, for instance, might use microfiche to store records like old land deeds or census data. Even though these records may not be frequently used, they must be preserved due to their historical importance. Why microfilming or microfiching? Space efficiency. Microfilms take up much less space than physical files. For large archives of documents that must be kept for many years, this is a cost-effective solution. Durability. Microfilm can last decades without deteriorating, making it ideal for storing documents that need to be preserved long-term. Retained in its original form and stored elsewhere. Archiving. Explanation. When files are no longer needed for daily operations, but still have value for legal, financial, or historical reasons, they can be moved to archive storage. This involves storing them in their original format, whether physical paper or digital, in a secure location. Purpose. Archiving is a way to free up valuable space in the active filing system, while still keeping the documents accessible if needed in the future. It also ensures that records can be retrieved easily if necessary, often after a predetermined period. Example: employee records. Imagine a company has a file containing employment records of employees who have retired. These records are not actively used, but are important for future reference, such as for pension verification, tax audits, or insurance claims. The company can archive these files by moving them to a separate storage room or digital cloud system, where they can be kept for a number of years. Project files. A construction company may have completed project files that contain detailed drawings, permits, and correspondence. Once the project is finished, these files might not need to be accessed regularly, but must be stored for future liability or insurance purposes. Instead of keeping them in the active filing area, the company moves them to an archival system. Why archiving? Organized storage. Archiving allows an organization to maintain documents for long periods without them cluttering up the day-to-day operational filing systems. Easy retrieval. Archived documents are organized systematically, allowing for easy retrieval in case they are needed for audits, legal inquiries, or other reasons. 3. Securely destroyed. Explanation. When files are no longer needed and there are no legal or regulatory reasons to keep them, They are securely destroyed to protect sensitive information and ensure that it is permanently removed from the system. Purpose. The destruction of files is an essential part of information management. It helps reduce the risk of data breaches and ensures that personal, confidential, or proprietary information doesn't fall into the wrong hands. Sensitive data. Destroying files is particularly important when dealing with sensitive information, such as customer data, employee personal information, or company secrets. This reduces the potential for identity theft, fraud, and other legal complications. Example: old customer data. A retail company might have customer credit card information on file from years ago. If these transactions have been completed and there are no ongoing business relations with those customers, the company may securely destroy the paper or digital records containing that sensitive data to prevent misuse. Employee personal information. After an employee leaves the company, their personal records, e.g., address, bank details, medical information, might no longer be needed. However, these documents must be securely shredded or permanently erased from the system to ensure confidentiality. Why secure destruction? Data security. Ensuring that personal and confidential data is destroyed properly minimizes the risk of identity theft and keeps the organization in compliance with privacy laws such as GDPR, General Data Protection Regulation. Legal compliance. Some countries and industries have strict rules about how long certain records should be kept, and others require documents to be destroyed after a certain period to protect privacy. The importance of a retention policy. A retention policy is a crucial framework for any organization. It sets out clear rules for how long different types of information should be retained and when they should be discarded, archived, or destroyed. This policy helps to ensure that the organization maintains compliance with legal and regulatory requirements regarding the retention of records, prevents overaccumulation of outdated documents, which could become a liability and a waste of storage space, improves efficiency by clearly designating how long information needs to be kept and when it can be removed from the active system. Examples of how the retention policy is applied. 1. Medical practice. Medical records for patients need to be stored for a certain number of years after their last visit. The retention policy might specify that after 7 years, these records can be archived or destroyed, depending on patient consent and legal requirements. Records that are no longer active, e.g., completed medical treatments, are either archived for future reference or destroyed once the retention period ends. 2. Financial institution. Banks are required by law to keep records of financial transactions for a number of years, such as tax filings or loan documents. These records may be microfilmed for long-term storage or archived digitally in a secure, centralized location. Once the retention period is over, records like old bank statements may be securely destroyed to prevent identity theft. 3. Government office. A government office might have tax records that need to be stored for decades. These files could be microfished for long-term storage. After a certain period, if these files are not being referenced often, they would be stored in archived locations. If records are outdated and there's no longer a legal requirement to retain them, they might be shredded to ensure sensitive information is protected. The dangers of not having a proper retention policy. Legal issues. If an organization doesn't properly manage its retention policy, it could face legal consequences if it is unable to produce required documents during audits or litigation. Storage clutter. Failing to archive or destroy outdated records can lead to a cluttered and inefficient storage system. This makes it harder to locate important documents and slows down day-to-day operations. Security risks. Improperly discarded files can lead to data breaches or the exposure of confidential information, which can harm the organization's reputation and lead to legal consequences. Conclusion. The methods used to handle files that are no longer needed on a daily basis, microfilming, archiving, and secure destruction are crucial components of a robust information management system. Each method ensures that information is handled appropriately depending on its relevance and legal requirements. A well-designed retention policy helps organizations manage data efficiently, comply with regulations, and maintain security, all while avoiding the unnecessary clutter of outdated records. Understanding retention periods for different types of documents. Retention periods are a critical component of an organization's information management and legal compliance policies. These periods define how long various types of documents must be retained before they can be discarded or archived. Retention periods can vary depending on legal requirements, organizational needs, and industry-specific standards. Different types of documents have different retention periods, which can range from temporary storage to permanent retention. Let's break this down in detail, using the UK Companies Act and other relevant legislation as examples to understand the retention periods for various documents. 1. Documents concerned with the legal establishment of the organization. Permanent retention. Explanation. Certain key documents related to the establishment of a company must be kept permanently. This is usually to comply with legal requirements or to maintain a historical record of the company's formation. Examples: Certificate of Incorporation. The document that formally establishes a company as a legal entity in the eyes of the law must be kept permanently. This serves as proof of the company's legal existence and is required for various legal purposes. Memorandum and Articles of Association. These foundational documents define the company's rules and objectives. Since they outline the company's structure, governance, and operational principles, they must be retained for the entire lifespan of the company. Why permanent retention? These documents are essential to demonstrate the legitimacy and legal framework of the organization. They might be needed for legal actions, audits, or other official procedures that could arise during the company's operations. 2. Annual accounts, permanent retention. Explanation. Under the Companies Acts in the UK, annual financial statements, which include the balance sheet, income statement, cash flow statement, and accompanying notes, must also be kept permanently. Examples: financial statements. These records provide a detailed snapshot of the company's financial position and performance over a specific period. They are required by law to be maintained for historical reference and for audit purposes. Audit reports. Audit opinions and the auditor's report are also part of the permanent records, since they verify the accuracy and compliance of the company's financial statements. Why permanent retention? Financial history. These records provide crucial insights into the financial health and history of the company. They may be used for legal proceedings, shareholder meetings, or regulatory inspections in the future. Compliance and verification. Governments and regulatory authorities require companies to produce these records as part of ongoing financial compliance and taxation. 3. Simple legal contracts, 6 years. Explanation. Simple contracts, which are generally straightforward agreements between parties, such as standard business contracts, typically need to be kept for a defined period, commonly 6 years under UK law. This period ensures that the contract can be referred to in case of disputes or legal actions. Examples: supply contracts. A company might have an agreement with a supplier outlining the terms of the supply of goods or services. If a dispute arises or the terms of the agreement are questioned in the future, the contract should be available for review. Employment contracts. Contracts with employees, which outline the terms and conditions of employment, should be kept for 6 years after the termination of employment, in case any employment disputes or legal claims arise. Why 6 years? The 6-year period aligns with the typical limitation period for most contract-related legal actions. This means that, under UK law, an individual or organization generally has up to 6 years to bring a legal claim regarding a contract. 4. Sealed contracts, retention period, explanation. More significant contracts, especially those involving legal matters that are more complex or that carry greater financial implications, need to be kept for 12 years. These contracts are usually sealed, which means they carry a formal legal weight. Examples: property deeds. If a company enters into a legal agreement to buy or sell property, such a contract will typically be sealed and should be retained for 12 years. This allows for reference if there are issues related to the property or its ownership in the future. Long-term service agreements. Some contracts that last for many years, such as long-term leases or franchise agreements, may also be sealed and need to be kept for 12 years in case disputes arise later regarding their terms. Why 12 years? The 12-year period allows for a long statutory limitation period in case there are disputes over the validity of sealed contracts. Sealed contracts often involve higher stakes and can have far-reaching legal consequences, making it essential to retain them for longer periods. 5. Tax legislation and minimum retention periods. Explanation. Tax laws may specify the minimum retention periods for various financial records that are critical for tax reporting, auditing, and compliance purposes. These records often have to be retained for several years to ensure that a company is in compliance with tax laws and can verify its financial transactions when requested by tax authorities. Examples: invoices and receipts. A company must keep records of all its sales and purchase invoices for a certain period, usually 5 to 6 years, as these are necessary for tax purposes, such as income tax or VAT returns. Tax returns. Copies of submitted tax returns and any supporting documents, such as bank statements or payroll records, must be retained for a specified number of years, typically 6 years after submission. Why retain for a specific period? Audit and review. Tax authorities may audit the company's accounts and financial dealings. Keeping these records ensures that the company can prove that it has paid the correct amount of taxes and adhered to tax laws. Statutory compliance. Failure to comply with these retention periods could result in penalties or fines from the tax authorities, or a lack of necessary documentation to resolve a tax dispute. 6. Public bodies and permanent record keeping. Explanation. Certain public bodies, e.g., government agencies or public sector organizations, are legally required to keep certain records permanently. These records might need to be available for public inspection or for the historical record. Examples: government legislation records. Bills, acts, or regulations passed by the government need to be preserved permanently for public access and future reference. These are crucial for the transparency of governmental processes and for legal research. Court decisions. Records of court cases, judgments, and legal proceedings are maintained permanently for historical purposes and public access. Why permanent retention? Public access and legal precedent. These records may serve as the foundation for future laws, legal decisions, and policy making. They may also be required for historical documentation, reference, or research. 7. Discretionary documents. Explanation. Some documents may not have a legal or regulatory requirement for a specific retention period, and the decision on how long to keep them is left to the discretion of the organization. Examples: internal memos. Memos regarding internal meetings or discussions that do not pertain to legal obligations but are used for reference might be kept as long as they are useful. Marketing materials. Brochures, advertisements, and promotional materials may not have a fixed retention period and can be discarded when they become obsolete or irrelevant. Why keep them? The general principle is, if you think you might need it, keep it for as long as you might need it. This allows organizations to retain useful information even when not legally obligated to do so. In conclusion, In conclusion, retention periods for various documents are determined by legal requirements, the nature of the document, and the organization's needs. Documents like legal contracts, tax records, and financial statements may have specific retention periods set by law, while others may be kept at the organization's discretion. A good retention policy ensures that important documents are preserved for the right length of time, while irrelevant or outdated documents are either archived or securely destroyed, minimizing clutter and maintaining legal compliance. Thank you so much for watching. I hope you found the lesson helpful. We'll see you soon in Lesson 9, so make sure to stay tuned and keep up the great work. Don't forget to like, share, and subscribe to support the channel. Take care, and see you next time. Welcome to Lesson 9, where we're continuing Chapter 1 of FIA FA1 with a focus on the crucial topic of data protection. We're here to support you every step of the way as we dive into the principles and responsibilities involved in safeguarding information. To help this community grow, please consider liking, sharing the video, and subscribing to the channel. Your support makes a big difference and helps us continue bringing you quality lessons. Let's get started with today's lesson, and thank you for being here. Data protection refers to the set of laws, policies, and practices designed to protect individuals' personal information from misuse, ensuring their privacy rights are respected. At its core, data protection controls how organizations collect, store, process, and share data about individuals. This approach became crucial with the increasing amount of personal data generated and exchanged in the digital era, and it addresses issues like data security, lawful processing, and individual rights over personal information. In the European Union, the General Data Protection Regulation, GDPR, is the cornerstone of data protection law, providing individuals with rights such as access to their data, rectification, and the right to be forgotten. GDPR also sets stringent obligations on organizations to uphold privacy and security standards. Additionally, countries worldwide have introduced their own data protection laws, often influenced by GDPR, to address similar concerns and establish safeguards. For example, GDPR applies not only within the EU, but also to entities outside the EU if they offer goods or services to or monitor EU residents, making it one of the most far-reaching privacy regulations globally. Data protection is closely linked to the concept of privacy, which is recognized as a fundamental right in many countries and under international human rights treaties. Privacy ensures individuals' autonomy over their personal information, whereas data protection provides the mechanisms to enforce this right. Countries establish independent regulatory bodies, known as data protection authorities, DPAs, to enforce compliance with these laws, investigate complaints, and raise public awareness about data privacy rights. For instance, the European Data Protection Supervisor oversees such matters within EU institutions. For more information, sources like the European Data Protection Supervisor, EDPS, and the UK Information Commissioner's Office, ICO, offer detailed insights into the principles and requirements under data protection frameworks like GDPR and comparable global laws. These regulatory bodies provide comprehensive resources on rights, compliance, and best practices for organizations and individuals alike. Data protection is essential because it safeguards personal information, which is critical for individuals' privacy and security, and ensures that organizations maintain trust and compliance with legal standards. This protection is increasingly important with the rise of data breaches and cyber threats. Here are some key reasons why data protection is crucial, along with real-world examples. 1. Preventing identity theft and financial loss. Data breaches can lead to identity theft, fraud, and financial loss for individuals. For instance, in the 2017 Equifax breach, the personal data of 147 million people, including social security numbers, birth dates, and addresses, was exposed. This breach highlighted the risks when sensitive data isn't adequately protected, leading to significant financial and reputational damage for Equifax and making individuals vulnerable to identity theft. Number 2, protecting privacy rights and freedoms. Data protection laws like the EU's GDPR protect individuals' rights to privacy. For example, GDPR's right to be forgotten allows individuals to request the deletion of their personal data if it's no longer necessary for the purpose it was collected. This right empowers individuals to control their digital footprint. For instance, if a person decides to remove old job listings from search engines, GDPR enables them to do so, enhancing privacy. 3. Maintaining trust in businesses and services. Data protection practices help organizations build trust with customers. For example, Apple emphasizes privacy and data protection by encrypting data and limiting data sharing with third parties, a practice that has reinforced user trust. Organizations that prioritize data protection are more likely to retain loyal customers and attract new ones who value their privacy and security. 4. Complying with legal standards and avoiding fines. Non-compliance with data protection laws can result in hefty fines. In 2019, British Airways was fined £20 million for failing to protect the personal and financial information of over 400,000 customers. This case demonstrated the legal and financial consequences of neglecting data protection measures, underscoring the importance for organizations to adhere to data protection regulations such as GDPR. 5. Protecting national security and critical infrastructure. In sectors like healthcare, energy, and finance, data protection is critical for protecting national infrastructure. For instance, healthcare organizations handle sensitive patient information, which, if exposed, could lead to serious harm for individuals. In 2017, the NHS in the UK was hit by the WannaCry ransomware attack, affecting thousands of computers and jeopardizing patient care. This attack emphasized the importance of robust data protection measures for public safety and national security. Data protection is thus vital for individual privacy, business integrity, legal compliance, and national security. With increasing digital data creation, secure data handling practices are essential for organizations to protect both their stakeholders and their reputation. The failure to protect data can have severe and far-reaching consequences for individuals, businesses, and even governments. Below are some major consequences of inadequate data protection, illustrated with real examples from the UK. 1. Financial penalties and legal costs. Organizations that fail to protect data often face significant financial penalties. Under the General Data Protection Regulation, GDPR, companies can be fined up to 4% of their annual global turnover for serious breaches. For example, British Airways was fined £20 million in 2020 after a cyber attack compromised the personal and financial information of over 400,000 customers. This fine, though reduced from an initial £183 million, underscored the high costs associated with data breaches, not only due to penalties, but also because of compensation claims and legal expenses. Reputational damage. Data breaches can severely harm an organization's reputation, impacting customer trust and brand loyalty. In the case of TalkTalk, a major telecommunications company in the UK, a cyber attack in 2015 exposed the personal data of approximately 157,000 customers. The incident led to significant reputational damage, with thousands of customers canceling their contracts due to privacy concerns. Following the breach, TalkTalk suffered financial losses, including an initial £400,000 fine from the Information Commissioner's Office, ICO, along with long-term reputational harm and lost revenue from customer departures. 3. Operational disruptions and recovery costs. Data breaches can also disrupt operations, as organizations often need to halt activities to assess and fix vulnerabilities. In 2017, the National Health Service, NHS, was hit by the WannaCry ransomware attack, which led to widespread disruptions across healthcare services. Many appointments and procedures were canceled, and IT systems across hospitals and clinics were down for days, impacting critical patient care. The NHS faced recovery costs estimated at £92 million, highlighting how a lack of adequate data protection measures can lead to costly operational disruptions. 4. Loss of sensitive personal and financial data. The exposure of sensitive personal or financial information puts individuals at risk of identity theft, fraud, and financial loss. When UK retailer Dixons Carphone suffered a breach in 2018, data for 10 million customers, including personal details, was compromised. Many of those affected had to monitor their accounts and report potential identity theft, underscoring the risk to individual security when companies fail to protect data adequately. Number 5. Increased regulatory scrutiny and oversight. Repeated or high-profile breaches can lead to increased scrutiny and regulatory oversight. Organizations may be required to implement stricter data protection measures, participate in audits, and improve internal compliance practices. For example, following the data breaches involving British Airways and Marriott International, the ICO and other regulatory bodies called for enhanced cybersecurity practices across industries to prevent similar incidents, impacting business practices and budgets across sectors. These cases from the UK illustrate that failure to protect data can have far-reaching consequences, impacting everything from financial stability to customer trust and operational integrity. Ensuring robust data protection practices is not only a regulatory requirement, but also a critical factor in maintaining business resilience and public trust in an increasingly data-driven world. Data protection legislation, like the Data Protection Act, DPA in the UK, establishes clear regulations regarding how organizations store and manage personal information about individuals, ensuring that their privacy and rights are safeguarded. Here's a more detailed breakdown of what this means and why it's important, particularly for businesses. 1. Purpose of data protection laws. Data protection laws, including the UK's Data Protection Act and the GDPR, General Data Protection Regulation, aim to ensure that personal data, such as names, addresses, health information, financial records, and other sensitive details, are kept private and secure. These laws outline strict guidelines on how data should be collected, stored, processed, and shared. 2. Impact on business departments. Within a business, the departments most affected by these laws are usually personnel or human resources, HR. HR departments manage sensitive information about employees, including personal identification data, medical records, performance reviews, payroll information, and more. Protecting this data is critical because it directly impacts individuals' privacy, security, and rights within the organization. Inadequate handling of this information could lead to breaches that compromise individuals' private information. 3. Risks from lack of data protection. Without robust data protection policies, organizations are exposed to various risks. Unauthorized access to personal information. If data is not adequately secured, there's a risk that unauthorized parties, like hackers or even internal employees, could access confidential information. For example, if an employee's health records were accessed without permission, this could breach their privacy and potentially lead to discrimination or harm. Inaccurate or misleading data. Data protection regulations require that information stored about individuals is accurate and updated. If incorrect data, like an error in a credit score or a criminal record, is stored, it could lead to serious consequences, such as affecting a person's ability to obtain a job or a loan. Incorrect or outdated information that spreads rapidly and cheaply in digital form amplifies the potential harm. Misuse of data for unintended purposes. Data protection laws also regulate that personal data should only be used for the purposes it was initially collected for. For instance, if an employee's data was collected to process their payroll, but was later shared with a marketing department to analyze consumer trends without the employee's consent, this would be a breach of data protection law. Such misuse could damage trust between employees and the organization and even lead to financial penalties. 4. Example of data protection in action. An example is when a company like a hospital collects sensitive patient information, such as medical histories, for treatment purposes. Data protection laws ensure that this data is only accessed by authorized medical staff and not shared outside the organization or used for marketing without explicit consent. If a hospital employee mistakenly shares patient information with an insurance company, this could be considered a breach, potentially resulting in a fine and a loss of trust in the hospital. In essence, data protection legislation is crucial to maintain the privacy and integrity of personal information, safeguard individuals from harm due to data misuse, and protect organizations from reputational and financial damage. Data protection legislation, such as the UK's Data Protection Act, DPA, and the General Data Protection Regulation, GDPR, is aimed at protecting individuals' personal information and privacy in a digital world. This legislation sets boundaries on how organizations collect, store, and process personal data about individuals, not about corporate entities. Here's a breakdown to make it more understandable with real-world examples from the UK. 1. Scope of data protection. The legislation focuses on protecting data about identifiable individuals, specifically personal data. This includes any information about a person that allows them to be directly or indirectly identified, such as names, addresses, health records, and employment details. For example, a hospital in the UK is required to secure patient data like medical histories to protect patients' privacy. Information about companies or organizations is generally not protected unless it directly contains personal data about individuals, such as employee information within a corporate structure. 2. Types of data covered. Data protection covers two types of data handling. Automated processing. This includes data processed by computers and other automatic systems. For instance, a bank managing customer account information digitally must follow data protection rules to prevent unauthorized access. Manual processing. The legislation also applies to manually created records, like paper files or ledgers, as long as these can be systematically organized to access individual information. For instance, if a healthcare provider uses a filing cabinet with organized medical records for each patient, they must secure this information to comply with data protection standards. 3. Definition of personal data. Personal data includes any details about a living individual that could reveal something about their identity, even if it's indirectly through identifiers like a customer or employee ID number. In the UK, for example, employment numbers in a company's payroll records would be considered personal data, as they are linked to specific employees and could be used to access their payroll, tax, and contact information. 4. Data controllers. A data controller is the entity, either an organization or an individual, that determines how and why personal data is processed. For instance, in a UK retail company, the HR department often acts as a data controller for employee records because it manages how employees' personal information is stored and used. The data controller has responsibilities to ensure this data is protected, used only for legitimate purposes, and accessible only to authorized personnel. 5. Real-world example. In 2020, a UK retail company, British Airways, was fined by the Information Commissioner's Office, ICO, after a data breach exposed the personal details of over 400,000 customers due to inadequate data security measures. This case illustrates the importance of data protection and the accountability of data controllers to secure personal data and prevent unauthorized access as mandated by data protection legislation. Data controllers in the UK, as well as third-party data processors, often referred to as Computer Bureau, are required to register with the Information Commissioner's Office, ICO, which is the regulatory authority for data protection in the UK. By registering, data controllers declare their data processing activities, which adds transparency and accountability to how they handle personal data. Here's a closer look at key responsibilities and the rights this legislation affords to individuals, with real-world examples for clarity. 1. Limiting data usage to registered purposes. Data controllers must restrict their processing of personal data strictly to the purposes they have registered with the ICO. This means that if a company registers to use customer data for marketing purposes, it cannot then use that same data for unrelated activities, like selling it to third parties without explicit consent. For example, if a retail company in the UK registers customer information to manage sales and improve customer service, using that data later for advertising without informing customers would breach these requirements and could lead to fines or enforcement actions. 2. Data protection principles. Data controllers must comply with the data protection principles, which establish rules for managing personal data securely, fairly, and transparently. These principles guide the ethical handling of personal information, including keeping data accurate, up-to-date, and only as long as necessary for its registered purpose. Violating these principles may lead to penalties and compensation claims from affected individuals. For instance, the UK telecommunications company TalkTalk was fined in 2016 for failing to follow adequate data protection practices, which allowed a breach exposing customer data to unauthorized access. The case highlighted the importance of strict adherence to data security principles. 3. Rights of data subjects. The legislation grants individuals, referred to as data subjects, several rights to protect their personal information. Right to seek compensation. Data subjects may seek compensation if they suffer damage or distress due to unauthorized disclosure, data loss, or inaccuracies in their records. For example, if a bank customer's personal information were mistakenly disclosed to a third party, and this resulted in financial loss or distress, the customer could pursue compensation through the courts. The data breach at British Airways, which exposed customers' payment card details, led to significant claims and fines, showcasing the legal recourse individuals have for privacy violations. Right to rectify or remove inaccurate data. If incorrect data is held about an individual, they can request that it be corrected or deleted. This right empowers people to ensure their personal records accurately reflect their identity and circumstances. For example, if a UK employee's job title is incorrectly recorded in their HR file, which then impacts their benefits eligibility, they can request this error be corrected to prevent further issues. Right to access. Individuals have the right to request and view the personal data a company holds about them. For example, under the Data Protection Act, a university student can ask their institution to disclose any personal information held in their records. Known as a subject access request, this right allows individuals to know what data is stored, helping them ensure their data is correct and used fairly. Right to know the purpose and recipients of data processing. Individuals are entitled to understand why their data is collected, how it will be used, and who may access it. For instance, a patient visiting an NHS facility in the UK may inquire about how their health information will be stored, processed, and potentially shared with other healthcare providers. This transparency allows individuals to make informed decisions about consenting to share their personal data. These rights and obligations are essential to protecting individuals' privacy and ensuring organizations maintain trust and responsibility when handling personal data. Organizations that fail to comply with these rules risk serious consequences, including hefty fines and damage to their reputation. The data protection principles serve as the backbone of data protection legislation, ensuring that personal data is collected, stored, and used responsibly and securely. Here is a breakdown of each principle, along with detailed explanations and real-world examples to help clarify how each one plays a crucial role in protecting individual rights. 1. Fair and lawful processing of data. Explanation. Data must be collected and processed in a manner that is transparent, fair, and legal. Information should not be acquired through deception or misrepresentation. Example. If a company wants to gather customer information for a loyalty program, it must explain clearly what the information will be used for and gain consent, rather than secretly using it for targeted marketing. For instance, if an online retailer in the UK obtained customer details by falsely claiming it was for account verification, but actually used it for marketing purposes, this would breach fair and lawful processing requirements. 2. Data held for specific lawful purposes. Explanation. Data should only be collected for clearly defined legitimate purposes. Once collected, it must only be used in line with those purposes. Example. If a charity collects donor information for processing donations, it should not later use that information to send unrelated promotional material without explicit consent. For instance, if a UK charity collected email addresses for donation receipts but then used them to send marketing emails without informing donors, it would be violating this principle. 3. Data must be adequate, relevant, and not excessive. Explanation. Only the necessary amount of data should be collected, and it should be directly related to the purpose for which it is collected. Example. If a UK university requires student information for course registration, it would be excessive to ask for details about their family members unless relevant to the registration process. An example of excessive data collection would be if the university requested details unrelated to the academic process, like marital status, which might be irrelevant to the registration. 4. Accuracy and up-to-date data. Explanation. Data must be kept accurate and, where necessary, up-to-date. Inaccurate data can cause harm and must be rectified or deleted as necessary. Example. A bank holding customer address data should update records when notified of a change, avoiding the risk of sending sensitive mail to the wrong address. In the UK, there have been instances where out-of-date credit information has harmed credit scores, highlighting the importance of maintaining accurate data for all customers. 5. Data retention. Only as long as necessary. Explanation. Personal data should not be kept for longer than is necessary to fulfill the purpose for which it was collected. After this time, it should be securely deleted. Example. An employer may retain employee information for payroll purposes during employment, but should delete it within a specified period after the employee leaves the company. For example, if a UK employer retained employee records indefinitely after departure, this would breach this principle, as data should be deleted after a set retention period. 6. Rights of data subjects. Explanation. Individuals have rights concerning their personal data. They can inquire if their data is held, access it, understand its purpose, and request corrections or deletion where appropriate. Example. If a customer requests information on what personal data a retail store holds, the company must provide access to the records, explain the purpose of data use, and correct any errors. In the UK, under GDPR, an individual might request their data be corrected if it's inaccurate, such as correcting an incorrect billing address held by a utility company. 7. Security of data. Explanation. Adequate security measures must be in place to prevent unauthorized access, alterations, or accidental loss of data. This principle emphasizes the responsibility of the data controller to enforce strong data security protocols. Example. A hospital storing patient information must use secure servers and limit access only to authorized medical personnel. If security is weak, hackers could steal sensitive patient information. An example of this in the UK is the 2017 NHS data breach, where a lack of robust cybersecurity protocols led to significant data exposure, underscoring the need for strong data protection policies. 8. Restriction on exporting data outside the European Economic Area, EEA. Explanation. Data can only be transferred outside the EEA if the destination country ensures an adequate level of data protection. This principle protects personal data from being moved to regions with weaker data laws. Example. A UK-based company cannot transfer customer information to a server in a country without adequate data protection standards. For instance, if a UK retailer decided to store customer data on a server in a country with weak data protection laws, this transfer would be illegal unless special measures were taken to ensure data safety. Each of these principles plays a vital role in data protection by setting strict boundaries on how personal information should be handled. These rules prevent misuse, help build trust, and protect individuals' privacy by ensuring data controllers and processors are held accountable for their data handling practices. Thank you all for joining us for Lesson 9. I hope you found it helpful and feel more confident in what we've covered. We'll be diving into Chapter 2 next, and I'm excited to explore the new concepts with you. See you there, and remember to keep up the